exemptions to recognition of assets under IFRS 16, definition of lease under both standard. Then key elements in a lease. So in this instance, you'll be looking at, say you are given a lease agreement, because what you will definitely see in practice is not a function of somebody having selected the figures for you. You have to look at a contract document and pick out the relevant points there as an accountant and communicate the possible implications of all of this intended lease agreement or a substantive lease agreement. Then lease and non-lease components of the transactions, you will see issues of relating to service charge, maintenance costs, and all of that. Does it relate or does it have effect on our presentation? If it does, how do we present it? So teaser 3, teaser 4 will be there. Financial statement adjustments. So where you now have typical issues which has initially been presented in line with IAS 17, and you want to transit, what happens? What needful adjustment do you need to make? Then teaser 4, impact of IFRS 16 on financial ratios. Sales and leaseback transactions, transition from IFRS 16, transition to, IFRS 16. Then explicit and implicit global benefits of IFRS 16. Then frequently asked questions and possible other questions and answers. So let me assess your own entry behavior. What is it that you're expecting from this class? Let's see whether it aligns with what our objective is.
How do you identify what type of lease it is? I know that IAS 17 was just operating and finances. Operating goes straightforward. Just the rental income. While the finances is the one that needs a bit of discounting and all that. That was IAS 17 was straightforward. But then the 16, I haven't even looked at it. I don't know what it contains.
Okay. So it is our intention that anyone who attended this class should, one, understand the new business perspective and the main changes brought by the new standard. So be looking at it vis-a-vis IAS 17, what has been the substantive position in terms of reporting wise, in terms of disclosure wise. Is the disclosure enough? Does it enlighten the intended users of the financial statements convincingly? If not, where were the pitfalls, right? In terms of financial analysis for decision making, what impact do we have, or what merit comes with IFRS 16 as compared with that of IAS 17? Then determine how these changes affect not only the accounting system, but also the business model relationship, right? So when you pick one financial statement of a company with another, or interdepartmental comparison, this comparison of various business lines, how, to what extent does it impact it? Identifying the main difference between leasing and other service contracts, right? I like to take a typical example of where we have, it's not a property of our home, so it is being rented, which is likely to be lease arrangements. What are the contract terms where we are coming in? The landlady will give, don't do this, don't do this. As long as you want to continue to stay here, you have to you have to ensure that you comply with this. One of those terms is that, oh, this is an estate. We just see security everywhere. Everybody pays for it. So you have to pay XYZ per annum. For your wastes, just put it outside there. The waste people will come and pick it. For doing that, you have to pay XYZ. Sometimes when you come in during the week, you see security at the gate there. It comes with some consideration. And what attracts that? The initial lease. Do you understand? If I say, oh, I'm not staying here again, I don't want to continue with the use of these premises, all that will not be there. So what impact does all of this have on the lease agreement? We need to understand what are the exemptions and the impacts in taking advantage of them. What are the exemptions and the impacts in taking advantage of them? Identify what are the steps to be further taken into adopting IFRS system. Then we'll be talking about, okay, is it a new company that has never reported anything? So it's a smooth and fresh take-up. There is no problem with, oh, what approach were they using before? What was the standard of compliance before? Then we may also have, or most likely we will also have entities that have always been operating. They've been complying with what IAS 17 says. So how then do we transit? Are we using full retrospective method as proposed by the standard, or are we using the alternative method, which is the modified approach? Do you understand? So I need to also emphasize that in a session like this, we may not have the whole time to pick the standard itself and be reading it page for page. But I think, and I know that from experience, it will do you a lot of good. So after this session, download the standard that we can share with you and read it word for word, right? It will do you a lot of good and actually concretize all of the issues and propositions that will be discussed in the course of this class. It is actually a common pitfall with a lot of accountants. I know a number of FCA today who has never opened the standard. They can quote everything. You just have to say you're a Christian, you can quote every version of the Bible, but you have never opened the Bible. So many of them, so many of them, so many of them. But I want to assume, or maybe I should not assume, I want to put to test certain underlying facts. We hear of IAS, IFRS, and all that. How does it come to play? What do you know about IAS, IFRS?
IAS, International Accounting Standards, standards used to be IAS, under the IAC, setting for the implementation of accounting practice to be harmonized globally, so that by it is done in Nigeria, we are done in the US, and again, some countries have adopted, some have not fully adopted, and Nigeria have adopted international financial reporting standards, which are the standards that govern how financial statements should be prepared and presented.
Okay. So Nigeria adopted it. That is the part that actually caught my fancy. When?
I know. Okay, it was a basis, because I worked with a company there, and we had to. I was part of the training to be like a transition, like PwC, and I think it started 2012.
Okay.
For financial institutions and public interest companies. And then the year of, I think 2013, it will be limited liability companies. And then 2014, first January 2014, I think, then SMEs and others.
Okay, let's have an idea. Okay, so which body actually publishes standards, these standards in Nigeria?
That would be,
Okay, so basically, the last one, what were we using before the IAS? SAS. We have had many SAS then. We had 31. We had 31. We had 31. So when we get there, we actually relate what we used to have in SAS. I think I will do that when I want to talk about tax implications of this. So technically, there were no much difference between what we used to have with IAS, but with IFRS, there were lots of difference, right? So lease accounting is previously regulated by IAS. So I assume that, oh, we are jettisoning the NAPS standard, right? So which was introduced because of abuse in the use of accounting, in the use of lease accounting by companies. What do I mean? I'll share the slides. Because if you have to jot, you will not be able to. So there is a particular standard or ratio we used to calculate. We call it asset turnover ratio. How do you calculate it?
asset turnover.
Yeah.
That would be that's turnover as a percentage of assets.
Okay.
Sales as a percentage of assets.
Okay, so then we are saying that what then is our assets? It is likening to what we call capital employed. Right?
Yes.
Okay. So we have company A and company B. Company A has PPE, 4 million. Let's say all other current assets, 2.5 million. And they made a profit of 1.5. Turnover of 10 million. Company B has the same 4 million, 2.5, 1.5, 10 million, but there was a leasehold, not disclosed here, but here we have 5 million. And you are told to calculate the asset turnover. The total asset we have in the first one, the total capital employed we have in the first one is what? 6.5. What we have in the second is what? 11.5. And we said the turnover is, the asset turnover is what divided by what?
The turnover of the asset.
So if I do this, 10 million, 10 million, what is the result of this? 1.1.
1.5.
This is 0.1.
0.9.
0 point something sharp.
Yes. Yes. 0.8.
Which company is better off? Or what is our parameter for determining which is better off? This is 1.5 times. This is 0.9 times. Huh?
Yes.
So which is better off?
1.5.
1.5. This is what happens with IAS 17. But the truth of it is that this company A also incurred the leasehold, but has expensed it. So that is where the concept of off-balance sheet comes into play. For smaller companies, it might not be so common or so material, but for most of the multinationals, lease arrangement in terms of intangibles, in terms of PPE and the like is so much and is very material, such that managers or management of businesses or directors can use these to manipulate depending on what they seek to achieve. If there is a proposed management buyout, that is, the directors of the management may likely take over some of the shares of the company. They'll put on metrics that will make the company unattractive. Do you understand? And if they then, on the other way around, seek to attract investors, they want to impress you that we're doing well. They'll put on metrics that shows that, oh, it is very attractive. So these are one of the so many issues that IFRS 16 came to cover. So when I read that lease accounting is previously regulated by IAS 17, which was introduced because of abuses in the use of lease accounting by companies, this is a typical example of what I was referring to. The standard that standardized the accounting treatment and disclosures of assets held on the lease. IAS 17 lease define lease as an agreement whereby lessor, being the real owner of the property, conveys to the lessee, who is the beneficiary user of the property, the right to use an asset for an agreed period of time in return for a payment or series of payments. So that is why also, if you look at it technically, lease can be a synonym for rent, right? Any objection? Good. So we're still trying to lay a good foundation, right? So IAS 17 identify two types of lease as far as IAS 17 is concerned. In our local standard, the position is the same, right? It was the same. So the standard recognizes that you may have a finance lease, you may have an operating lease. What is a finance lease? It's very much good to say that it's a long-term lease. That is a layman's way to explaining it. There is a possible potential that because the lease period is almost equivalent to the useful life of the assets. Technically, we may say that upon the completion of the lease period, there is a higher likelihood that the assets will have been worthless, right? So because of that, there are in some contracts caveats that, upon the completion of the lease period, the said lessee may take over the assets. I presume, it's not stated anywhere, I presume that why most user or most lessor will always put that caveat is that it gives the lessee a sense of responsibility and commitment in the use of the assets. If I know that I will still take it over in the long run, I'll be more careful with it. And that's a typical example of what we see in Nigeria when you get a car and put it on public transport. The drivers will drive it recklessly. But tell them that, use the assets for XYZ, I will just give it to you at a takeaway price. when there is any minor fault, the guy knows that I will take it over, or he will take it over at the end of the period. He will be more careful with it. My opinion, anyway. So, finance lease is a lease that transfers substantially all the risks and reward incidental to ownership of the asset. So if I know that I'll be using it in the long run, there is a very high likelihood that, oh, I will take an insurance policy, I will regularly service where necessary, make requisite or relevant repairs as demand, and use the right parts when I'm even replacing worn out parts. Title may or may not, so it is not sacrosanct that you have to transfer ownership, right? It all depends on the decision of the contracting parties. Then operating lease is any other lease that is not a finance lease. So I often ask jokingly in any of my sections on lease, what kind of lease is marriage? That is the reaction I have from virtually all of most of my students. It's a lease, it's not your property. You fumble with that woman. The real owner will come out. You know, they say, we've given you and all that, it's your own. You just fumble with that woman. The real owner, the real lessor will come out and say, oh, mommy. So technically, it's a finance lease. Because it will be absorbed. You get married 1-2 years, lady is sick, God forbid, you now take it back to the owner. Say, Oga, you're a man. So it's technically a finance lease, right? So it's also important to clear it here that most of the time when the lease or contract agreement is being drafted, because it's more likely that the agreement will be drafted in the absence of the opinion of an accountant or a tax consultant. The technical terms as known to us as an accountant may not be used. So don't look forward to having, oh, this is a finance lease between Mr. A and Mr. B. So you are now to look at the terms, the condition, the characteristics of that agreement to know, if all these things are there, okay, it is a finance lease. Or if all of these things are there, indirectly, it is a what? Operating lease. So the lease classification set out in IS 17 was subjective. Do you understand? Because depending on how you tweak it, you will still have, okay, let me give you another instance. Jokingly, when growing up, I was with my people one day, and in one of the family houses, they said they have a tenant that spent well over 35 years in the house. Do you understand? What kind of lease is that? But based on the characteristics that we have laid down and the one we will still explain further, it still looks like an operating lease. Because the guy does not pay for 35 years. Do you understand? He pays some of them even pay every month, quarterly, but annually. Do you understand? Then we will likely also emphasize this because it can come up also in practice. Anything relating to land and building, any lease arrangement, no matter how, it is most likely to be an operating lease than a finance lease. Do you understand? So let's look at it. Why? Most definitely than not, except for building, there is no real damage that is likely to occur. Do you understand? And all all land is actually government owned. Say you have C of O, you're just on your own. Still government owned. And the maximum lease term is 99 years. Do you understand? There is no lease you will give to anybody for that same equivalent 99 years. Do you understand? Even if it is the bank that is taking it off, it is not up to half of the useful life of the assets. So technically, it's still an operating lease, no matter how long it lives. Do you understand? So the lease classification set out in IAS 17 was subjective, and there was clear incentive for preparers of lessees financial statement to argue that leases should not be classified as operating rather than finance lease. So you still have that contention amongst accountants that when you have lease building that looks like, oh, it is long in nature, they still report it as that finance lease. Do you understand? But the benchmark that the standard say we should use to compare is the actual useful life of that asset with the lease period. Do you get me? Before you can classify anything, a car, no matter how good it is, will serve well at least in the first 4 to 5 years. So if I'm taking a lease arrangement for 4 years, it's as good as I'm taking over the car. But if I have a tractor that is as sound, or an aircraft that is as sound as being 20 years, and I take a lease term for 5 years, it's not a long-term lease. But it's debatable. A lot of people will not agree. But what's the good thing about the standard is that the standard has also provided that if you have any reason why you didn't agree with the proposal or proposition of the standard, you're allowed to use your contrary view, but state why you think that your opinion is superior to that of the standard, so that whoever that wants to use it will understand the basis of your decision. Then I think that clears it. This is what we refer to as off-balance sheet financing. It is for this reason that IFRS 16 was introduced. What then is off-balance sheet? So I will not waste time on this. I've explained all of that. So, but there is one area that I need to emphasize here. Under IAS 17, lessee needs to classify the lease as either finance lease or an operating lease. But as far as the lessor is concerned, what classification does it give to it? It can still be a finance lease and operating lease. So if the lease was classified as an operating lease, then the lessee does not show assets and liability, which was what would have happened here in the statement of financial position. But you have, while we then argue under IFRS 7 and 16 that those things most likely that you are calling operating lease, they're actually assets. That's where the argument comes from. Let's look at the definition of an asset. So if you look at the basic characteristics of an asset, they meet all of those definitions. So that's what brings about the tweak you have in IFRS 16. So it is only the lease payments that will be recognized as an expense. And how will that be done? How we've always been used to, even in the days of SAS, is when the lease is actually accrued, you debit the lease expense or the rent expense, and you credit the lessor. And eventually, when the payment is made, you then debit the lessor and credit your bank. But if it's a cash transaction, immediately, you debit your lease and you actually credit your bank. Is that clear? So over the years, the level of transparency in the financial statements of corporate entities become questionable. I've also explained all of that there. Any question? So there is a little comparison that we have to make in IAS with US GAAP. What is US GAAP? Okay. So according to Forbes, in January 2006, the IASB estimates that over 85% of lease commitments held by listed companies using current IFRS standards or US GAAP do not appear on their statements of what? Financial statement. That is because before the introduction of IFRS 16. Do you understand? So, and it makes performance, their share price and everything very, very attractive. Precisely about 85% of lease obligation operating lease are off balance sheets because they do not appear on the statement of the financial position. The global standard of Aaron and WorldCom, I don't know whether you remember the story. It's actually also traceable to this deficiency. Took some of the operational routes from those practices of what? Off balance sheets financing using special purpose vehicles and related mechanisms. Any question? So this also just further explains that. You can go through that for your reading digest. So treatment of an operating lease. So we've been able to establish now that you have both the, what do we call it? Operating lease, and we have a finance lease. An operating lease, according to IAS 17, is a lease that does transfer significantly. Tell me whether this is correct or not. That does transfer significantly all the risks and reward associated with the use of the lease assets. Yes or no? Exactly. I intentionally put it there. So it should be what? Does not. So I want to be sure that we're together. So unlike so what definitely am I trying to explain here? If it does not, this statement then supports what form of lease? Finance lease. So unlike the treatment of finance lease under IFRS 17, operating lease does not result in recognition of assets and liability on the balance sheet of the lessee. You have for the training, right? Please note that we are always very time conscious because we have so much to do. You have not done much, so you can still catch up. All right, so with this, you can understand what's the concept of operating lease, what the concept of finance lease, right? Now, the operating lease is accounted for in the books of the lessee by debiting the rental expense and crediting the accrued expense or back. Now, I need to make some clarification here. Most of the time when we are accounting for lease, we pay more attention to the book of the lessee. It is so because the major complexities we have is in the book of the lessee rather than in the book of the lessor. But that is not to say tomorrow you may not have lessor as a client, or you may not be working for a lessor. So if you don't talk about it, it then brings problem. So in most of the issues we'll be looking at, we look at what happens in the book of the lessor, what happens in the book of the lessee. Just to bring you to speed, today we are concentrating on accounting for leases, right? Don't bother, just jot the relevant points we need. We'll share the slide. So, what we have talked about thus far is we have not gone into IFRS 16 at all. We're still laying the basic foundation. We're looking at what happens in the days of IFRS 17. Do you understand? IFRS 17 actually defines what the lease is. It goes further to explain what are the nature or characteristics of various lease arrangements we likely have. Right? Then we're able to identify that peculiarly we have operating lease, we have finance lease. So this very area I'm trying to explain relates to an operating lease. So in the book of, are we together? In the book of the lessee, who is the lessee? The lessee is the user of the what? Of the leased asset, right? So when it is an operating lease, the moment that lease transaction has taken place, right? On credit, now I told you it can be a credit transaction, it can be a cash transaction, right? If it's on credit, the accounting entries first leg will be debit the lease, or simply call it rent, credit the lessor. Are we there? Then when you now make the payments, right? You then debit the lessor and credit the what? The bank or the cash. But if it's a cash transaction, you simply debit the lease or the rent and credit the what? The bank. Or cash, as the case may be. Right? Then in the book of the lessor, what happens? I need somebody to explain to me how the credit transaction will be done and how the cash transaction will be done. What's an idea? So what can you help? Which one are you explaining first? The credit? Okay. You debit the lessee's account and credit your what? Revenue. When payments then comes through, debit your bank and credit your lessee. That's correct, right? Because to the lessor is an income. Same way with a cash transaction, just debit your bank street and credit your revenue. That's very correct. But this is what an accountant will do. A tax man, tax people will be waiting for you. But we'll talk about that. That's a different section. So we now look at each of these. What are the tax implications? So that when you're making a report for your employer or your clients, you will then have to factor the tax implication, not when the tax authority now comes and say, oh, you didn't book this withholding tax, you didn't book this VAT, and all of that. Okay. I believe there is no question. Okay, so the amount to be recognized in the income is on a uniform basis. That is the income statement, whether it is a lease, in the book of the lessee or that of the lessor. So even if it appears that we are paying for more than one period, it is still, if it still meets the definition of an operating lease, right? you have to recognize the income or expenses on a pro rata basis. Now I told you that you don't just off your head because the period of the lease arrangement looks longer. You don't just conclude this as a finance lease. Do you get that? Very important. So you have to compare the lease period with the useful life of the leased asset to know whether it meets the definition of a finance lease or that of the operating lease. I've seen instances whereby you have a lease period that is almost equivalent to the useful life of the asset, but the risk and reward that comes with the use of that very asset does not go to the lessee. Do you then conclude that it's a finance lease? It's still not. If I give you a car on lease for 4 years and the useful life of the car is 4 years, and I told you part of our agreement, if anything happens to my car, bring it back to me. Don't touch it. I have my mechanic. I have my this, I have my that. It is still what? Operating lease, not a finance lease. So the concept of the risk and reward actually emphasized is a determining factor. So also you could also have some operating lease that looks like a finance lease, right? Most often than not, when you take some rental, wherever, the landlord or the landlady will have told you, oh, any capital defect in the house, whether interior wise or exterior wise, I will handle it. But in reality, check with your landladies, see, or like your landlord, they will say, particularly if they don't live there with you. Say, oh, guys, go and do it. And if you like, don't do it. So technically, what are you having? You're having a finance lease that looks like. All right, so it is the one. Can somebody read this for us?
The pattern of payment for the Nonlease rentals payable in arrears as follows. Year 1, rental of 50,000, including service charge of 10,000. Year 2, rental of 58,000, including service charge of 18,000. And year 3, rental of 52,000, including service charge of 12,000. How would IFRS account for this lease in its financial statement?
So who is the lessor, who is the lessee? Okay, so what are the things to do? We are accounting for a whose book? Okay, so if it's in the lessee's book, year 1, tell me what accounting entries you are to pass. Who is helping us? We are assuming that we are having an average income statement. The only expense there in that period is 50,000. But it would be wrong if I just report rental or lease 50,000 because there is a confidence of service charge. So when during the tax class and the session, I will tell you the disadvantages of combining these together. Do you understand? If you mistakenly, or let me even mention it now. If you mistakenly report these together, your rental or lease is liable to withholding tax if it is between corporate entities. Do you understand? Because it's more likely to be likely to a contract But as an individual, you rented an apartment from a fellow individual, you can't say you want to deduct withholding tax. So if I then report my rent as 50,000, when the tax people comes, they say withholding tax at the prevailing rate on the total. But what this service charge means, all those auxiliary services, cleaning that may not necessarily attract withholding tax, or if it's a service apartment, consumables, generator and the likes. So you do your client or your employer a lot of savings, provided as contained in the contract, specifying the service charge as distinct from the rent. So I will then report year one. My rent is 40,000. Service charge is 10,000. If the contract, if the transaction has not been paid for, my statement of financial position average blah 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 blah. Year one, and we then have what? The lessor 50,000. This is the interpretation of what we earlier said, debiting lease or rent, but it's just that because we now have another component. Remember at the beginning of this class, I explained something like non-lease components. This is a non-lease component. It is a transaction that is incidental to the lease arrangement. It's not the lease itself. And I need you to pay special attention to it, because when we now get to finance lease, we now need to be doing a lot of decouplements. That is where the concept of discounting factor comes in, present value, future value, and all of that. So you have 40, then you have the service charge. Then credit what? The lessor. 50. Is that okay? So the same thing will be replicated in the second year. Rental, irrespective of which approach, let's even make it more practical. That, in my client's business or my employer's business, we now use the software. Maybe Wave, maybe Tally 9. Don't just post it directly. Make sure that you have a chart of account for each of those. Are you there? Now, for tax purpose, ordinarily, I'm just assuming that this is for accounting purpose because it's not a tax class. But you're expected to be a complete, you should be 2 in 1, an accountsman and a taxman. What I would then have to do, if I want to put the tax perspective into consideration, I will then not credit the lessor with 50,000. You get it? I will credit the lessor with what? With 36,000 plus 10,000. That is 46,000. I will then say withholding tax payable. 4,000. Assuming it is rent is usually subject to withholding tax at 10%. So when I will be paying the lessor, if I then come in here, I will have 46. Then withholding payable. That is what? 4,000. So it depends on the nature of the lease. There are some lease arrangements that will also be vatable. You will then need to factor the VAT into it. Is that clear? So because of time, I'm sure you'll be able to handle this and that of the February. So you can go on. Any questions first?
Is it possible that within the period there is an increment?
Yes, it's possible.
If we treat it individually, like for example, if Apex Corporation pays lease is stating 40,000, we paid in advance of 120,000.
Okay.
Probably on the second year or something, there's no increments, or you cannot pay this increments, you can vacate, you have to.
It's possible. It's possible. It's possible, particularly where that leased asset is actually now competitive. Maybe the landlady or the landlord actually saw a bank that wants to take it and they are proposing, not necessarily a bank, any other person, proposing a higher sum. So it's possible. But it is now left for whether you are willing to concede to it or not. But it could also be a litigation issue. Do you understand? Just like you are prepaid your rent with your landlady or your landlord, now comes in and say, that one you have paid before, it has now increased. You have to top it up. So the bottom line of it is that you have to make reference to your rent agreements. Do you understand? But sometimes some of these litigation issues, it goes beyond what you as an accountant can do. You would then have to make reference or recourse to your company secretary or lawyer to advise you. So that is where the concept of contingency comes in. Do you understand? If the lawyer then say, with the way this case is going on, you may likely lose the case. And as a result, eventually either pay the extra or leave the place. You may then have to make the appropriate bookings. But when we say something is contingency, what standard is that? So you know what the standard talks about contingency. You just have to make disclosure. Making disclosure says that in one of the relevant sections in the notes to the account, if I have to make contingency, the notes, my regular account will have relevant notes. I'll then have to say maybe note 4 when I get to the note, say the rent has been booked based on the agreement at 40,000. However, there were blah 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 that were called, and the case is presently in court. Our findings from our lawyer says that there may be a consequent contingent liability or contingent asset that become there, resulting to. So anybody who wants to use the account must have that underlying understanding. Otherwise, you will then have misinformed the public. Do you understand? That is the disadvantage of using IFRS. IFRS, you have to say everything said. Don't hide anything. When in the days of SAS, you can keep it in your mind. Everything. You say, we are looking for the makeup of this figure. It's in my mind. Without the accountant, you cannot overrule anything. But IFRS will tell you the portion of the account that we call the accounting policy. It tells you a lot of stories. What even informed us choosing this policy? Why is it 5%? Why is it a lot? So it's always very, it's not very interesting. As interesting as it is. I remember there was a case like that I handled for one of my clients. And you know that when, imagine when you go to a tax office with a client, they will think, particularly those ones that think that they want to be righteous. Before you ask them A, they will have mentioned A, B, C, D, E. You don't know that the more you say, the more you are enlightening yourself. So most of the time when I go to a client, I'm in tax office like that with my clients, I make sure that they sit beside me. And I will have had a mutual agreement with them. If you see me shake my head like this, I say, shut up, don't talk. Or I just match you. Otherwise, you just be, that is the disadvantage of IFRS. It requires you to say so many things. And the more you are saying it, the more the taxman will just be waiting and they say, okay, he said this, from this, what is the tax implication of this? Before you know, your tax is so enormous. All right. So, season 2. Mrs. Precious is the managing director of CCPLC and has requested for the advisory service of the firm, KCP, on the appropriate treatment of the lease transaction a company just entered into. These are some of the issues you could have. Your boss might not just tell you, oh, you just recently attended, or you told me you are attending social training on lease accounting. I have one lease arrangement or contract, come and advise me on what it is. This is a typical example. So the details of the lease transactions is below. The company leased a machine under a 4-year lease from Bam Bam Limited. The term of the lease are that the annual lease rental are 2 million payable in arrears. As an incentive, Bam Bam Limited granted the company a rent-free period in the first year. The annual lease rental is inclusive of an annual service and maintenance cost required. Explain to her how the lease will be accounted for in the company's financial statements. So can you advise? Mr. K, let's start with you. Because everything about this, we've mentioned it. So, of course, you know that it will be in a report form, right? But for the sake of understanding and time, tell me what you will have. Assume I'm your client or your employer, and I don't have accounting background. Advise me. Relevant facts on the agreements are as extracted, because that will have been the source of all of this. Okay. Okay. Exactly, it's very important.
Okay. So how then do we account for this? Now, the first year, there's no payment at all.
Yeah. That is an incentive.
That's an incentive. Okay. So which means there's nothing to account for.
Okay.
And then in the second year, we stayed in arrears. So at the end of the year, we assume it's accrued, so it's not to be paid for yet. So we're going to, of course, debit the lease rent expense and credit the lessor, which is non-bound.
Okay.
Credit the lessor. And like you rightly explained, we need to be mindful of the tax implication, so we don't lump them up.
Okay. Do you totally agree with him? Okay, let me share. Let me hear your view. Okay. 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 I will advise that Accountants are people that pays attention to details. And you should assume zero knowledge when you are dealing with your clients. Most of the time, when my client requests for an advice, most of them that knows me very well will say, please, just give me bullet points. Because I will assume that you don't know anything. So I will give you the preamble, first of all. The preamble will tell you about what you request me to do. You have sought for social advice and this, you provided me with this. The next one we talk about my understanding of the expectation, so that we'll be sure that we actually understand each other. This is what I understood about what you are asking me. Then I'll now keep on highlighting each of the case. So let's start with each of them. The company leases a machine for a 4-year period. Obviously, since I don't know the useful life of the machine, I will assume that what is most likely to have occurred is for it to have had a longer time than this. That's the normal thing. If it's otherwise, I will emphatically stress it that, oh, it is this. 2, the term of the lease are that I will pay a 2 million payable in arrears. There is an off payment for first year, and inclusive, that is why I mentioned about the paying attention to the lease in details. That 2 million already includes the annual service charge. So it's important that we actually determine the service charge or the maintenance cost. But what happens if we cannot, right? Benchmarking is then allowed. We then have to look at, maybe within our environment, or in the industry, we use that kind of machine. How much does it cost in a year to actually service it and to maintain it? So let's assume that in a year it costs us 500 for servicing and maintenance, right? The lease time is 4 years, but I'm to pay for 3 years. Multiply by 2 million. That will give 6 million, Service cost will be 500 times 3, 2. Because technically, if I'm not paying for the first year, they say included in the rental is the service charge. So if I'm not paying for first year, I'm also not paying the service charge and maintenance cost, right? So indirectly, I'm paying 500K times 3. That is 1.5. So the rent is then 6 million minus 1.5, which is what? 4.5. And the service charge is 1.5. What you then do in accounting is this. There is no free period. This 4.5 will be divided by 4. Because if you don't allocate a cost to that year, you will have overstated the profits. You understand? So it's what you have here that you now report per year, the same way we always do it. Then these two will be divided by 4 and treated as a service charge across the 4 years. Do you understand? No person wants to do business on lease. That person that says, I'm giving you first year free. If you are going to do other survey, it's possible the actual rate is 1 million. Nobody wants to lose. If they tell you, buy 2, take 1 free, you actually pay for 3. Do you understand? So that is, and of course, we pay attention to all the tax implications that we have earlier explained. Your VAT, your WAT will then be on the 4.5. because you had rightly splitted the 6 million into the lease component and the non-lease component. Is that clear? Okay, good.
Okay, for most normal rentals, you pay in arrears. For the first year, going free. The second year, you actually pay for the end of the year. It simply means your journal entries will not, if we're following this, your journal entries will not follow the mode of payment.
Okay, so this is what you will then have done. Because it's an agreement that covers those 4 years, even though you are still paying in arrears. In my workings or in my notes, I will have explained and done all of this analysis. In that my first year, what is the resultant effect of that 4.5 divided by 4? Hmm? 1,000,005. So what I will still debit as my rent is still 1,125,000. Abi? My service charge is still, what would that be? $375,000. And what I will then credit as due to the, sorry, need water. There is socket on. Do you understand? So the lessor will then have that, even though it is not due there, you will still book it. Even your withholding pay on this, you still book it. Then as you pay, you then credit and debit the relevant account. Hope it's clear. So we can read this for us.
Entered into an agreement to lease a machine by Crown estimated for 4 years. The lease period is also 4 years. At which point the asset will be returned to the leasing company. Annual rentals of $5,000 are payable in arrears from 31st March 2020. The machine is expected to have a new residual value at the end of its life. The machine had a fair value of $14,275,000, so $14,275,000. At the exception of this, the stock includes the finance cost of 15% per annum when calculating final rent. How should this be accounted for in terms of the net of
Okay, so let's not take it one after the other to make it more explanatory. On 1st of April 2009, Bridgeco entered into an agreement to lease a machine that had an estimated useful life of about 4 years. The lease period is also 4 years. So what kind of lease is this? What kind of lease is this? At which point the assets will be returned to the leasing company. Annual rental of $5,000 are payable in arrears from 31st of March 2009. I mean 10. You need to compare the period. So that's definitely March 1 year. So the machine is expected to have a nil residual value at the end of its useful life. The machine had a fair value of $14,275 at the inception of the lease. That is the actual cost of the machine. The lessor includes a finance cost of 15% per annum when calculating the annual rental, right? So if you look at this, if I'm taking a machine of 14,275 and I'm paying 5,000 for 4 years. 5,000 times 4 gives me what? 20,000. The difference between the 20,000 and the actual cost of the asset is what? That is the finance cost. That is the finance cost. Do they say is there any non-lease component there? Is there any non-lease component there? No. Okay. So I'm going to do it this way. This question, the earlier ones we've solved is on operating lease. This one we are solving now is on what? Finance lease. So can we all just take with our phone, take a snapshot of this? I'll pull it down. I want to solve it on Excel spreadsheet. Can I go ahead? Okay. So I will explain. I initially prepared these for different questions, but we'll use it to solve this very same question. That teaser was teaser what? 3. Okay, so what is the annual lease? 5,000, have we? Do we have any non-lease component there? Okay, please look up 0. The lease component is still 5,000, right? The non-lease component is 0. Now, that is the step one. Because in every lease arrangement you have, you need to ascertain whether there are, from the lease payments, whether there are lease components and non-lease components, right? So the next one is determining the present value of the minimum lease payment, right? This is an arrangement for how many years? So you should have year 1, 2, 3, and 4, Abi. Now, our discount factor here is what from the question? So somebody will need to help rework this. You know how to calculate the discount factor? 1 over what? Oh yeah, is it back when?
1 plus
Mm-hmm.
open bracket 1 plus 0.15. Minus 1.
So it's actually equals to 1 plus what?
Open bracket, no, equal to open bracket 1 plus the rate, that's the interest rate, which is 15%.
That will be 0.15
Then close the bracket.
raised to power.
Minus 1.
Where is power here?
Shift and then raised to power minus 6.
Minus 1, right?
Yeah. And 0.8.
Okay. So actually should not have put this, that is why it's showing me. Okay. So if you multiply this times the cash flow, gives you this, right? The next one is 5,000. Because that is what you will pay every year. Here we are having, it's now year 2, right? You're having 5,000. This is not year 3. I'll share these sheets too. Year 4. What is the total you have? What was the total they gave us as the cost of the assets? So this is, I intentionally did this. There are some questions you will not be given the actual value of the assets. Do you understand? This is how to calculate it. Do you understand? Because you might just be asking yourself, you read through a lease agreement. There is nowhere in the contract where they said this was the actual cost. The lessor might be looking at what is your business with? Maybe the cost is for me. So why should I state it there? So, but this is the technique with which you will ascertain what the potential cost would have been. Is that clear? So the next stage is now, if this is then the actual cost of the assets, this is what you are depreciating. Is that clear? Because why the finance lease is different from the operating lease is because, one, you write it off entirely in the year the expense was incurred. Even when payments are made for more than 1 year, you rather defer the excess as prepayment, right? But in this instance, you are recognizing that finance lease as your assets. So you report it as an asset, call it finance leased. These are the popular items you see as leasehold premises, leasehold properties, leasehold this is the asset itself. Do you understand? Are you with me?
Yes.
So you are subjecting it to depreciation the same way you will have subjected your regular fixed asset to depreciation. So what are we doing? Here we have been told that the assets cost 14,275. How many years? So is that value you are also depreciating 4 years? So this is the depreciation you will charge every year. 3 what? Straight line, yeah. Except otherwise stated. Right?
The company is using a different depreciation.
Okay, so what you then have to do so that you won't most time be making an assumption in practice. Every organization should have their accounting policy. So in their policy, they will have stated that any assets of this form, machinery of this form, our depreciation rate is XYZ. Except where the assets you are having now, this finance lease, is not in any way related to an existing asset. Do you understand? But most definitely than not, you will have seen it in the policy of the company that all our assets is depreciated on straight line basis, or all our assets is depreciated on reducing balance method, or all our assets is depreciated on some of the year digits, or we are using evaluation method. They will have stated it in the policy. So make reference to the policy, make sure that you are familiar with the company's policy. But the problem you have with most of the SMEs is that we will know. So make reference to the last audited accounts, and you leverage on what the auditor must have stated as the accounting policy. Is that clear? Because we've audited so many companies, and when you get to when you're auditing them for the very first time, and you ask the accountant or the manager, I mean the MD there, what's the accounting policy? Which one is that one? Please help us. Do you understand? But if the company has an existing one, make sure you are not working against what the policy says. Otherwise, when the auditor comes, that will be the first spot of error that, okay, your policy says this, you're using this. Is that clear? So one thing you have to do first of all is initial recognition. Initial recognition. So when you are initially recognizing the assets, at what rate do we recognize it? 14 to 75. Don't forget we are still under IAS 17. So I will just say debit the leased assets and credit the what? I've not paid entirely for the assets. Leased liabilities. With how much? 14,275. Is that clear? Then the next one is now to depreciate the assets. Depreciation every year. You will now debit P or L with what? Depreciation of and credit the leased assets with 3,568.7. Hope this is clear. So irrespective of you use an automated accounting software, just debit the right account and credit the right account, and make the relevant disclosures in the notes. Maybe another training I might be doing in a public platform is we pick some selected accounting software and we do. Which one do you use? Wave. I use Wave very well. Because people need to know how to use most of these accounting software. All right, so that's that. Let's now come into the lease liability. You see, initially when we did the calculation randomly, we got the difference between the actual assets and the actual sum we are paying. Do you understand? So we now want to show how that calculation will be made, which is the lease liability. What are we trying to do here? We want to ensure that the finance cost, which is the essence for we paying extra, is being noted. So the first time it is 14,275. Don't forget, we are paying in arrears. This calculation will be different if we had paid in advance. So we are paying in arrears. First year, we are still owing 14,275. The interest rate is 15%. So we do the same thing. It will be 14 times 15%. That is the amount that accrued. How much do we pay? 5,000. What will be the balance is the net of this. We give us that. So I'm summing this together. 14,000 plus 2,000 minus 5,000 I paid. So what I will then be owing in the second year, as at the beginning of the second year, is 11,416. Then I will calculate the interest on that same outstanding too, when I will now pay 5,000 also. Do you understand? Then my balance will be this. But this payment, in this case, was just for the lease component alone. Do you understand? In some other question you have the lease payment and the non-lease component. So if it were to be that we have non-lease component as part of the payment, it is the non-lease component, it is the lease component alone that we recognize. So that is the net of it. Then year 3, I will have this balance brought forward, right? Then calculate an interest on it. Then make the usual payment. Then the difference, right? This year 3, year 4. I then have this same sum. The interest is this, the payment is this, and if you look at it, what is the balance? Nil. So that then means that the total interest for that period is this. And at the end of the day, I don't have anything, right? So how do I put, so it then means that every time I pay 5,000, there is a portion for the actual assets. There is another portion for the interest. I've recognized the one for the actual assets, which is what I've written up. In my P&L, third one, recognition of interest. Recognition of finance costs. I will then have to debit my P&L with the finance cost. And credit what? Exactly. Because you see the one that is taking the money. As far as he is concerned, he's just taking a rental income. Do you understand? It is in your book as doing all this. So if I were to work in the book of the lessor, I'll just recognize one straight jacket income. You get that? So this liability. Now with how much? What we have calculated in the first year. This time we are not using straight line. So you have 2, 1, 4. That's what you do year 1, year 2, year 3, year 4, year 5. Is that clear? So I'll take my time to do the first one. This is my leased asset. That initial debit I said we should do. Year 1. What is it? What will be the whatever here? Lease liability of it 14,275. Coming here, lease liability. In my year one, it is leased assets 14,275, which was that pair of entry we did. Year two, second entry is between P or L and my leased assets. That same year one, I will have depreciation 3,569 approximately. I will come in here and say year one, what is it? Depreciation, right? Depreciation of leased assets 3,569, right? That completes the second pair of entries. Then year three, what am I saying here? Third entries, the finance cost. Still in year one, my finance cost is 2,141, right? Corresponding entry this same year, finance cost 2,141, right? You total this. Don't forget our last entry when the actual payment was then made. Recognition of payments. We then do what? Debit what? Debit lease liability and credit what? Bank of cash. So come in here and say year one, bank 5,000. Balance carried down will be the difference. Balance carried down will be the difference. In my balance sheet extracts, we are closing this as a total extract. In my balance sheet extracts, year one, I will have PPE, the balance there, right? Under the liability, I will have leased liability, the balance there. Is that clear? In some instance, you might choose to separate the finance cost in a separate ledger if you so prefer. Do you understand? So however you want it. So that's what you're to do in year one, year two, year three, year four, and okay, year four is the last one. So for someone who then use Wave will not give you, are you listening? It will not give you an avenue to make all of these workings, right? So what I then do, because I use Wave here too, what I then do, some of those issues that Wave will not allow me to use to make all the working, I will make my workings in an Excel sheet. Remember where I make my postings, there is a place where you can attach documents. Have you observed that? Oh, you pay me for showing you. Let me quickly. No. What about you? Because I've been using it for long. This is when they now detect that a lot of Nigerians have been using it. Yeah, it has always been free. So, but if you are coming on board now, it will be free for 1 year. After which you will now be. Let me see. Let me just show you. Let me just show you. So this is how the web environment will appear. So this is my wave environment. If I then now want to make the posting, I now come in here. Let's assume I want to recognize the expense. I can select the dates, make my narration here, select the GL here, then there is a place here, this place. Click it. You can then come in here where you have receipts. Attach your source documents here, where you can now see your workings. Can now go and pick it wherever I've kept it. Can say, oh, let's assume this is my workings. Attach it. So that later on, if you want to review or the auditor comes around to want to review anything I've done, they can make reference to that and save it. Yes, it's applying in the journal. Apply in the journal. Because when you do your monthly payroll too, that's what I do too. When you do your monthly payroll, Wave does not, that portion is a paid version. I can't use it. So I do my payroll manually. When I'm now posting it, and I attach the payroll there. Even my vouchers, I use the web solutions as a complete online software. I don't keep any paper vouchers again. So when I make any payments and erase the voucher and all the receipt, whatever, I just come in here, convert it to a soft copy, and attach it that same way. Do you understand? So probably maybe we'll be doing a training on this much more later on, but it's an interesting solution. All right, so this is how we are to, what is expected of us. We need to speed up a little bit. But trust me, all of these preambles, we will give you a solid foundation in IFRS 16. So you can take your time when I share the slide to look at this example 4. It is a similar concept to the one we have just solved. Then same with example 5 too, right? A similar concepts. Then this one is also on operating lease, a similar concept to what we have done before. A similar concepts. You remember I solved one on initial rent free. right? It's a similar concept to this too. All right, so the main business. The new standard IFRS 16 for lease accounting was released in January 13, 2016 by the International Accounting Standard Board. The history of the development of IFRS 16 goes back to 2006. The new regulation was replaced the previous IAS 17. At least you now have a good understanding of what IAS 17 is all about. IFRS 16 will take effect, or has taken effect, I should say now, with effect from 1st of January 2019. So if you are preparing your accounts, let's say you have accounts of clients or employers for period before this particular period, and you fail to say that as of today, that I'm preparing 2014 accounts, right? IFRS 16 is in vogue, right? I can still decide to do early adoption. Do you understand? But there is a caveat there, that if I choose to adopt IFRS 16 for period earlier than 2019, an early adoption is permitted, but only if the company applies IFRS 15, right? So we're talking about IFRS 15 much more later on. That's on revenue, right? So ensuring that the performance obligations has been fulfilled, right? Then IFRS 16 eliminate the classifications of lease as either operating lease or finance lease. So the concept of we have two types of lease does not come to play again. We only have one type of lease. All lease are classified as finance lease. However, you can then have some lease arrangement that we call them small or short-term lease, right? That looks exactly like the regular finance lease. Operating lease. We can then treat them in one way. When we get there, we will talk about it. But here, as far as IFRS 16 is concerned, we only have one type of lease, right? Instead, all leases are treated in similar way to finance lease. IFRS 16 makes significant changes to the way in which leasing transactions are reported in the financial statement of the lease, although not in the financial statement of the lessor. So as far as the lessor is concerned, IFRS 16 does not change anything about how you account for lease transaction in the book of the lessor. Do you understand? Everything still remains the same. Lessor can still say, I have an operating lease, I have a finance lease. But as far as the lessee is concerned, you can only have a finance lease. However, there could be some short-term lease. Do you understand? So the objective of IFRS 16, I've encouraged you that you must don't be part of those accountants that knows the standard but have never seen the standard itself. Make sure that after this session, maybe I will share it with you too. The real standard itself, try to go through it, right? It makes more meaning after having listened to a lecture of this nature, right? So there are basic things that every standard will always talk about. We always talk about how do you recognize that transactions that meet its recognition criteria? How do you measure it? How do you present it? Presenting it means that how does it appear on the income statement? How does it appear on the statements of financial position? How does it appear on the statements of cash flows, right? Then disclosures. Disclosure is talking about how do you report it on the notes part? What are the things you should say that makes whoever that is using it to actually have a good understanding of it? Is that clear? So IFRS 16 does not apply to the following. So when you see issues of this nature, you should not apply IFRS 16 at all. One, lease to explore for the use of mineral oil, minerals, oils, and natural gases is not in any way relating to IFRS 16 because there is a distinct standard that talks about how you account for that. Then leases of biological assets, that is agriculture, that is better taken care of by IAS 41, right? Rights under leasing agreements, licensing agreements, I mean to say, that is well catered for intangible assets in IAS 38. Then service concession arrangement, that is IFRS 12. There is a different or separate standard and interpretation that takes care of all of this. So anything outside all of this is then being covered by IFRS 16. I hope I'm not too fast. Good. So what has changed? Of course, you talk about the single accounting model as opposed to the two accounting model using finance and operating lease. That is the basic thing that has changed. So lessees will not classify the lease as finance or operating. Instead, all leases are recognized in the balance sheet, similar as finance lease before the change. Remember, we did an illustration about what could be the possible analytical impacts of still using operating lease when in reality, the nature of the lease actually meets recognition as an asset, right? So now, when you now want to report every lease as a finance lease, the standard now goes further to giving you its own nomenclature, right? So we don't now say leased assets again. You now have right of use of assets and lease liability. Do you understand? So when you used to use, I used leased asset before because we were still talking about IAS 17. So now you should talk about ROU, right? Rights of use of assets. So what else has changed? We talked about this single reporting model, accounting model. No significant change in the book of the what? Lessor, I've explained that. Then sales and leaseback transactions. The accounting for sales and leaseback transaction depends on whether the sales meet the definition of sale under IFRS 15. But what is sales and leaseback first? You're using terminologies. I always like to simplify my class. A typical way for me to explain sales and leaseback is marriage. And I will explain it. The parents of the bride will tell you, giving you. In Yoruba, they will tell you, you don't take money. In the Igbos, they will almost cut your head. But what they have done, when they now come, let's say they just come to visit you, they will still say, my daughter. They have rights over that child. Abi? What they have done is a typical way to explain sales and leaseback. You needed something. I have this house, but I need money because that is the whole idea about it. I need the building for my business. I sold it to you. And I still come back to you, paid me the full sum. And I came back to you and now say, I want to rent the property back. So indirectly, what I'm only telling you is, borrow me money. Do you understand? So the standard talks about that you will only recognize it as short on a condition that it meets the performance obligation under IFRS 15. But I will explain this better. But you understand the concept of the sales and leaseback now, right? I have an asset, maybe a laptop, right? I need it. But why business does that is because they need money. So they just give out what they need, what they still use in the business. They sell it to somebody and say, we are selling it to you on the condition that you still lease it back to us. Is that clear? So then, unlike before, that you can just do your abracadabra and go. Now you have to tell us everything that happened. So more disclosure is required, right? So I put this in this way, just a kind of summary. You can compare IAS 17 with IFRS 16. Finance lease and operating lease was the cash cow then, but now all leases are just the same. Then here, when we used to have finance lease, we recognize assets and liabilities. Here we don't recognize any assets or liabilities. But here, because we only have one type of lease, we recognize assets, we recognize liability. Then operating lease encourages off-balance sheets rights or obligations, but here there is nothing like that because you have actually recognized the asset. So it is imparting on every ratios that you want to do. And by extension, this does not also encourage off-balance sheet transactions. So reason for change from IAS 17 to IFRS 16, I believe I've explained all of this to you because it's majorly centered on off-balance sheet arrangements. So can you tell us what off-balance sheet arrangement means? No, it's actually something that should actually appear either as asset, liability, or equity on your balance sheets. That you have reported it in a way that will make it not to appear there. Do you understand? Okay, what is the definition of an asset? Something I incur, I spend or expended money on in the past that gives me future economic benefits, right? Good. This building, this flat is for the company, right? I incur money on it in the past. It's generating income. Abi, ordinarily, technically, is an asset to me. Because it meets all the conditions of an asset. But I will still not report it as an asset. And in the illustration I then gave of a company A and company B that has 40 million assets, PPE. This one too has 40 million. Let's say our firm is this, another firm is this. We have the same client base. Do you understand? We do the same kind of service, we build the same way. So our turnover is 50 million here. We also have 50 million here. But we have lease assets now. Assets or right of use. So let me use that. Right of use. We did not recognize, but this company recognized 10 million. If I want to do my asset turnover ratio, what is the asset turnover here? Because as an investor, you want to analyze how well this company has been using its asset to generate sufficient income, right? What is the calculation here? Because the parameters are turnover over asset, abi? So I will say 50 million divided by 40 million. That will give me what? 1.25. 1.2 times, abi? This other one will be having, what is my total assets? It's PPE plus this. It is 50 over 50. And this will be 1. So if you want to invest, which company would you have said use its assets to generate more money? Company A, right? But technically, they are on the same level. So what has given room for this to disclose improved performance is because it has encouraged what? It has adopted off balance sheets. Can we go on? So I believe we are on the same page now. Exemption to recognition of assets under IFRS 16. A primary example of IFRS 16 is that all leases, all lessee leases should be reported on the balance sheet. IFRS 16 does not, however, require a lessee to recognize assets and liabilities for short-term leases. Leases of what? 12 months or less. And leases of low-value assets. Do you understand? So there is this caveat that if I rent or lease apparatus like laptop, the value that consideration I'll be paying does not command or attract that effort to doing all those complex calculations and all of that. So you are permitted to just write it off. We are writing it off the same way we will have treated operating lease. Just debit the lease expense, right? And credit the bank. Do you get what I'm trying to say? So that is the exemption there. However, in Nigeria, we say FRCN is our standard issuing body. They did not specify what a low value asset should be or could be. So you stand a chance to now decide what is a low value asset to company A, what is a low value asset to company B. However, in the international space, in the UK, you have 3 assets of 3,000 or less would then be qualified, but in the US, it is assets of what? 5,000 or less, right? So the write-off will be done that way. So I believe I've explained all of this too, just trying to tell you what we call it here, and now we are using right of use. So one important concept here is that according to IFRS 16, the customer must be entrusted not only with the right to use the assets, but the underlying assets must also be in its control, right? Remember that was also the intention under the original finance lease, right? Before I can say something is a finance lease, I must not only have control over it, but there must be an evidence that the risk and reward that comes with it, which is a typical explanation or display of the control, right? So that's that. Okay, I think there is something here. I've also explained this one before, where we say that in IFRS 16, you must now take time to decouple the leased payments, separating it into the lease component and the non-lease components. So the key elements in lease, according to IFRS 16, includes: can an asset be identified? Can you actually identify the asset? If yes, does the lessee obtain the economic benefit that comes with having control of that asset? If yes, does the lessee direct the use of the asset? If the lessor will still dictate how you use the assets, then it does not meet the definition of finance lease. Okay, I'll go back to my explanation, my good very example of marriage. You say you have control, right? but your father-in-law will determine when your wife will go to party with you or not. You actually don't have control. It's still directing the use of the assets. It looks like you have all the features. So my point in essence is this: don't just go dogmatically to looking at every arrangement or contract that looks like finance lease and say, because this one is there, if this last one is not there, it's still not a finance lease. Because it means that you don't have control. All the conditions must be met.
It is not a short-term lease. Not effective. Another is a low value.
If this condition is not there, the most important concept in IFRS 16 is control. There must be display of control. You know how the IAS 17 define an operating lease is who determines the rate, who actually take, possession or benefits, the risks and the reward. So risk and reward is being de-emphasized in IFRS 16, but rather control. Do you understand? Now the difference is technically it's just a choice of words, right? If I say I have control, right? If local governments in this area is coming and say everybody that owns a flat here, we are giving them 1 million. Who takes the 1 million? If the landlord show up and say, I will take the 1 million. Do you understand? Then it means this does not meet a finance lease for me. Do you understand? If there is a major defect in this place and I have to call it out, oh yeah, madam, come and repair, then it means it's not a finance lease for me. So you should look at those technicalities. If all of those things are not there, particularly the control, and for reason best known to you, you still choose to report it as finance lease, then the standard says, tell us in your disclosure. Otherwise, you'll be misinforming the public. Tell us that you don't have control in this form. You know why? Somebody then who wants to invest. If I have this place and on a Sunday like this, I cannot come in, I can't have free access. You know, all of those shopping complexes, you won't have access on a weekend if it is not generally open for the public, right? And I want to make a sublease arrangement. And the form of business of that sublessee is to come on a weekend and use the office. If I have portrayed to the sublessee that I have full control, he has paid, make all the fixtures there. Coming in on a Sunday to having access to it, he cannot. So I've misinformed the public. So I should disclose that all of these things are there, but we don't have control. So whoever that wants to invest with them know that, if we don't have control, if the person still go ahead to making the investment and they could not use it when they so choose to use it and they sue you, you can then defend yourself. But I disclose that I don't have control. But if you don't disclose, you can face litigation. Is that clear? So these professions of ours is very, very sensitive. It's just that we don't follow contrary to the latter in Africa. If you'll be following the news, you see very of recent was it KPMG or PwC that is facing litigation for professional negligence in Asia, and they are paying through their laws. But Nigeria or some of the African countries, you can eat your cake and still have it. But it doesn't mean that we should not be cautious because something can just change one day and you have finds that ordinarily you will have edged with regular disclosure. That is why auditors will always say that it is the management that have the responsibility to prepare the account. Ours is just to come, view, and just make our opinion on it. So if in the course of the preparation of the financials or auditing the financials, there are some things that you cannot totally vet, I will tell the reporting accountant, Oga, give me a letter of comfort, a letter of representation that this thing, they might not know the implication of giving you that letter. I hold that letter. When the ship is down, but I got these exemptions and all of this is on this premise that I don't prove further. We probably also will start a public training on auditing section because a lot of so when I mention letter of comfort, representation, they are all auditing jargons. All right, so that's it. I hope I've been able to convince you and not to confuse you.
So the last part,
Okay.
if you know recognize it as a lease asset, sorry, the right of use asset. What, how do you know?
Right of use.
Right of use.
You see,
What do you know recognize?
accounts, financial reporting is highly judgmental. There is no right or wrong answer, right? Because if you look at the features of financial reporting, you see self-judgment and all of those stuff there. What we are just saying is that if you must do otherwise, this is what the standard has said. You can still say, oh, then the control is not applicable to me because I don't have anybody that will make decision on the basis of control or not. Do you understand? So if you must contravene it, tell us. Somebody else might still pick it and say, oh, despite the fact that this control does not exist, we still want to report it as a finance lease, but you need to disclose why you are making that contrary judgment. Tell us that condition 1 was met, condition 2 was met, condition 3 was not met, but we still choose to report it as such because of this and this and this. But better option is, since you don't have the control, then you have to take the short-term approach. The short-term approach does not mean that there could still not be payment over 1 year. Do you understand? Because I can still rent a low value asset for a longer period. It doesn't mean I have to now make it a finance leased approach. No. Are you getting my point? Yeah. So whichever area or whichever option you are taking, technically, if you look at it too, this IFRS system, nothing has changed.
Because my next question is okay, IFRS 16 wants to address that over. But can someone hide under that hold on there and say, I don't have control? I don't have control.
Yes. If you then
so that you won't have any.
Okay, so the best way to answer your question then is that you don't have control. You've treated it as though it's an operating lease.
Yes.
And you will tell us in the notes. I'm presently undergoing a CFA class. The way a financial analyst analyze financial statements is not the same way the accountant thinks. In fact, you will not appreciate anything and everything you have done in accounting if you don't take a course in financial analysis. Do you understand? All this your financial statement that you have prepared, we will scatter it and recouple it, rearrange it in a way that you can't compare Gary with label. So it's either we are converting everything to label and compare, or we convert the label to Gary and compare. My point is this: provided you told us that you treated it otherwise because of this condition, when I now want to do the analysis, I will know that my metrics for my component of assets includes that very value. Me as a financial analyst, I will know that the total asset you have, guy, you are just fooling me. Maybe you have experienced it. I will bring it and add it and get a real picture of the performance of the company. That is why IFRS tell us as much as possible. Don't just give us the figures. So whichever way you are reporting it, provided the disclosures are made, whoever that wants to make the decision, we still have the relevant facts, have the right understanding to still make the right decision. I hope that is clear. All right, so you need to identify the assets, know the feature of the assets, which is part of the measures I earlier explained, itemized here. Directing the use, which is also talking about the control, just a way to further explain all of that. The economic benefits has to flow to you, right? Which is also not far-fetched from what we have learned before. Then more importantly, we've talked about this before too, that every lease, don't just pick, oh, they are paying $5,000, whatever. Ask yourself further, which is part of the thing you will also have disclosed. Is this particular payment meant for the leased assets alone, or there are other figures there, underlying component there? So you need to, at every time, decouple that leased payment into leased payment and the non-leased payment, right? So this is just a further explanation of that every lease contract must be analyzed into the leased component and the non-leased component. Then here, this is just saying how we have to, that adjustment I then say, whoever that wants to, because I now have more detailed information, whoever that now wants to make use of that financial statement will make the needful adjustments. I will then reclassify or regroup what your asset component is, what your regular expenses is, and all of that. That's what I mean here. So those are the explanation. What I've explained here is just to tell you what adjustment you have to make in income statements, which one you have to make in statements of financial positions and the likes. And this story around that capital employed, the ratio we talked about before. So I've explained all of this. So yeah, let's look at this. Who will take this first? Tolua?
An entity entered into a lease agreement for the lease of a machine. Details of the lease agreement include the annual rental payment of 100,000 naira, including food and maintenance service, payable in arrears at the end of the year. Appropriate discount rate is 5%. The machine has an economic useful life of 10 years. Lease term is 2 years.
Okay. Okay, still a continuation of the question.
Yes. The standalone lease rental for similar machine is 90,000, while the service and maintenance charge is 10,000. The applicable discount rate is year 1, 9.52%, year 2, 0.907.
These are the discount factors that they've just calculated for you.
And required to analyze the information above as it would have been presented under the old standard IFRS 17 and the new standard IFRS 16.
Okay, so can anybody tell us what will have been the situation under IFRS 17 and IFRS 16?
Is the person would have prepared this as an operating lease.
Okay.
Very, very distinct compared to
Okay.
while IFRS
We treat otherwise, Abi. Okay, so there is something I want you to pay attention to there. The annual lease, the annual rental payment is 100,000, including a cleaning and routine maintenance services, right? That is a non-lease component part of it. Payable in arrears. Please be very careful when you say payable in arrears or payable in advance. The difference is that before you start to apply that discount factor on that asset value, that right of use, if it is payment in advance, you will have deducted it first. Because you can't pay, if I say I'm owing you, I'm taking this property and I'm paying in advance. You can't accrue interest on what I've paid in advance. There is no finance cost. Unlike I will use for the whole period and I will then pay you. So what brings about the concept of discount factor then is that if you had collected the money at the beginning of the period, it will have earned an interest to you. You understand? So you need to pay attention to that depending on what the contract says, right? Some contract will say payment in arrears, some contract will say payment in advance. So that will impair or impart what you are to do. Then I mentioned instances whereby there could be non-lease components of that finance, but you don't have the actual value, right? So you have to look for how you can benchmark. So here, the stand-alone lease rental for similar machine is 90,000, that is the actual lease. Then the non-lease component is 15,000. So let's see, we have to work this out. I hope you are making sense, small. So, but the beauty of this is don't just learn it and keep it. Engage meaningfully, engage, have continuous discussion. That's how you can retain the knowledge. And even if you don't have clients or employer having a similar issue now, offer yourself for free service. Do you understand? So if I were a consultant that does not have clients that has this peculiarity at the moment, I will look at what my fellow consultants are doing. Who are those that are still doing it the old way? Say, okay, this standard talks about this. Can do it for you for free. Do you understand? By so doing, you will have refreshed what you knew before. All right. So just the same way we have done earlier one, but pay one attention to this. You know, I said the actual lease rental is 100,000, right? But the standard says we should separate them into lease and non-lease component, but we don't have the actual value. But they gave us elsewhere that something similar to that has a non-lease component of 15,000 and a lease component of 90,000. So we will use this to now share the 100,000, because if you add this together, it's already more than what we are paying. So we have to do a fraction of that. So that's why we now come in here and say 90 over 105 times 100, right? Then the other one, 15 over 105 times 100. Is that clear? So you will see also that there is no material difference in this approach, even under IAS 17. It's still the same approach. So our discount factor now, because we have identified the real lease components, you know, in the first question we saw, the lease component was just given to us, right? So we have this now. We now say 85,714 at these discount factors, the same way we have calculated that other one, multiply it. This is now the total cost of the right of use of asset for the 3 years, even though the person will have paid 300,000. The difference between the 300,000 and the 233,000 is then the what? Finance cost, exactly. So it's now the 223,000 you are depreciating over the 3 years, right? You then follow that our approach to make the accounting entries, right? Then coming down, you are starting with the actual cost of that asset. Apply the interest rates. What I was then referring to, let's now assume that payments are made in advance. If payments are made in advance, this 85,000 will then come in here. It should then come in here. I will then also find the balance between this and this before I now apply my rates on the outstanding. That is the difference. Do you understand? So I will then have to say, okay, this is what is outstanding on which I will calculate the interest. Are you with me? You're not talking, are you confused? Is there any confusion? Let me take it again. Yeah, you know, you will always pay 100,000, but we've told you that that 100,000 should be decoupled into two because there is a non-lease component there, right? So in this your calculation, that non-lease component is although maintenance, security, whatever. We are not discounting that one. Do you understand? Because that is what they will always collect every period. But this one is they are paying at the beginning of the period. So I cannot apply the interest rates on this total because that was not what was owing at the period. The thinking is this: I want to pay somebody 233,000 over 3 years. Most definitely not. Just let's take this place as an example. I'm renting, let's assume what I'm paying is 100,000, but out of the 100,000, 85,000 is for the rents. If I have the agreement, I will use it for 3 years. I'm not paying the landlord 3 years in advance. Do you understand? So I've done my calculation. I've put this as this. What I'm now doing is that since I know that over 3 years I will pay 233,000, I can go and I will pay in arrears. I can go, if I have the money today, I can go and fix it in the bank and earn interest of 5%. The interest will come in. That's why I earlier, look at it. I fix the money. I won't pay anybody until the end of the year. I fix the money, I earn this interest. I liquidated the amount. I will have an investment, 159, still with my investor. They will pay me interest again on the balance. Do you understand? I will pay this, I will have the outstanding. Bring it forward again, pay the interest. This concept is similar to what we call sinking fund. Remember, in SFL, is the concept of sinking fund. I have an investment or a capital outlay X, Y, Z in the future. How much should I save now to earn certain interest to be able to meet that capital That's what we are saying. I'm now saying that alternatively, I am to pay upfront. What I will have to invest cannot be 233 again. I know that what I will pay over the 3 years is 233. But the landlady says, pay me in advance. So I will have removed 85,000 from this 233. Now invest in 147. Do you understand? It is on the 147 and interest of this will now accrue. Do you understand? So when I add these two together, I get this. So I'll now take this forward. Then I will pay the following year again. Sorry. I will pay 85,714 again, right? Then I will have the balance of 73. Then I will earn an interest of that. I will earn an interest of 5%. So the earlier calculation was wrong. I will earn an interest of 5%. That will be what the balance will be there. Then if I add this, no, this calculation was wrong. You know, it's this and this I'm now adding together. That comes in forward there. So second one, I will add that same two together. I have these two making up this sum. Do you get it? Now, when I bring this one forward here, the difference we would then have is that because I'm investing earlier, I'm paying earlier than when I could have accrued, right? I will then have a shortfall. What I will then have in balance is 72. But meanwhile, I'm expected to pay this. So I will then need to add the balance to it. So what it then means is that if I am paying in advance, my discount factor cannot be the same. I have to look for another investment that will pay me higher return to still be able to meet the total. You get my point? Are you following what I'm trying to say? So otherwise you will not meet the total. But ordinarily, this very question, I just use this one to explain the concept of paying in advance and paying in arrears. Because it's very, very, very important. Is that clear? So that's what we do for each of the years. Sometimes rounding error could make you have little differential. It just depends on the rounding, the estimate of variables you use. Any question there, we make the posting the same way we have done. Any question? Any question? Can I go on? All right. Okay, so this is a summary. I just did a summary of what we have done on that spreadsheet. This is another one. You can take your time to just look at it. All right, so what then is, that's majorly what it's all about, right? Thus far, what we have done has been able to address how we are expected to make the presentations. Because the presentation is all about how do you disclose all of these transactions on the face of the statement of financial position, on the face of the statement of income statement and the likes. But we're still talking about how do we transit, right? Then finally, we'll then talk about the tax implication. All right, so the impact of the ratios, I've explained some of all of these variables before. What is EBITDA? So I'm just telling you, we're just saying that because of the impact of IFRS 16, reporting it otherwise, your EBITDA will increase. But if you're using it in a previous manner, your EBITDA will have reduced, your EPS will have reduced because you have we have less variable that you are disclosing. Let me use that again. EBITDA is earning before interest, tax, depreciation, and amortization. Now, because if you're using this, right, you know, in the old approach, you will have the entire sum being reported as a lease expense. So if your total rent is 400,000, you will have written off everything 400,000. But here, EBITDA will only tell, I mean, in this IFRS 16 approach, you will need to amortize. You are not writing off everything. Do you understand? So your earning before interest, tax, depreciation, and amortization will be higher than it will have been in the first approach. So by so doing, it is having a positive impact. So you then see the reality of what happens to each of the companies. Where it is unfavorable, it shows it vividly. Where it is favorable, it shows it vividly. So that's all the concept here. So you also have total assets. You have more assets unlike before. The gearing ratio is, there is a tendency that you have higher gearing because you're having, as you're having more assets, you're having more liabilities too. So that is all we are trying to explain there. The concept of sales and leaseback, I said I will explain that better when we take IFRS 15. But just note that the concept here is that the summary of it is that business actually needs money, and they're looking for a short way to report, to actually fund the business process. Don't also forget that lease or leasing is also a source of finance. If you had the whole money, you would have gone to buy the assets in the first place. So it's a source of finance too. Then the transition. So what you need to know about the transition is that there are two approaches, because we've been reporting these lease arrangements before the introduction of IFRS 16. IFRS 16. So there was a different approach you've been using before. So the standard allows you to use either of these two approaches. Full retrospective approach. That then means that you go to the previous years and restate everything, all the rents that have been reported as such. You have to do all of those calculations and all of that, right? That is a full retrospective approach. Is that clear? So under this method, IFRS 16 will be applied retrospectively in line with IAS 8. So you then have to assume that, there is a changes in an accounting policy. We used to use this approach before. We need to do all of those disclosure requirements. You have a restated income statement, restated balance sheet, restated cash flows if you have impact on all of that. Then it means that you need to restate all the prior. Okay, I've explained that, Abi. Then if IFRS 16 is adopted for the period beginning on 1st of January 2019, adjustment will be booked in equity on this. That is where you are still doing your you're doing your restatement. Also, all comparative information for the year 2018 will then be presented under IFRS 16. This method is more demanding because information relating to prior years will be presented under both this standard and the other standard. So the other option is the modified retrospective approach, right? Under this method, you need to apply IFRS 16 from the beginning of the current reporting period. It means that you do not need to restate the financial information for prior comparative periods, right? Rather, all the adjustment you need to make, you calculate all your adjustments and you make the adjustment on retained earnings that you have carried forward from that prior period. Do you understand? So you are just making adjustments on that. The comparative for that prior year will still show rents, whichever approach you'll be using, IAS 17, right? But you make the adjustment, and you see the practical approach. My partner will be handling that. Then this is just to give you a summary of it, of what I've explained, what happens under full retrospective, and what happens under the modified approach. The explicit and implicit benefits, this is just looking at generally what impact has this got to do with adopting IFRS 16 generally. ISB expect IFRS 16 to significantly improve the comparability of financial information. This is because companies will recognize assets and liabilities for all leases. So you then see the reality of what happens. Measure all lease assets and all liabilities, all lease liabilities in the same way. Then recognize only the rights that are obtained and liability that are accrued. Then this would inevitably facilitate more transparent and accountable financial reporting, as investors and financial analysts are better able. You know, I told you there that the analysts will not just take your accounts and go and be calculating ratios. No, we have to restate all the ratios. Just the same way you want to compare a company's performance in Nigeria, whose financial report has been prepared in line with IFRS, with a company that has been, that operates in US, which financial statement have been prepared with US GAAP. The thinking and the basis are not the same. So it's either we are converting both to IFRS or we are converting both towards US. RCFA now, something very crazy. All right, but it is interesting. So, and are better able to assess the financial position and performance of the company. So we talked about definitely, if you have to do all of that, you definitely be in a position to make a much more informed decision. Then improve and better disclosure, so everybody then knows what happens. So even if you are taking other routes, we know exactly what happened. If a non-informed investor about IFRS sees rates in the prior year, and this year they are saying amortization of right of use of assets. Okay, is it that you're not occupying that premises again? That's your disclosure will have informed the person that, oh, we did not report this way because we are transited from this and this. They know what happens. There will be a lot of issue with the tax authority because you are then using amortization of right of use. And you know what they already had is that anything depreciation or amortization, disallow. Do you understand? So if you then say disallow, okay, which capital allowance are you then giving me in lieu of the disallowance? Because I've had to fight a lot of battles on this. Whether you are using amortization of right of use of assets, it's an allowable expenses. But if you must disallow it, then you must give me the rate on which I will claim capital allowance on it. Do you understand? So why I keep on emphasizing this is that don't allow them to disallow it without giving you a compensation for that disallowance. Do you understand? That is one of the topical issues on its tax implication. So this is because information is not apparent to other investors. I think you have explained all of this. You can take your time to look at this. So the frequently asked questions are, why the new standard? I think you should be able to answer the questions now. Do we pay only for a lease or also for some other services? I think we've been able to answer that when we talk about lease components and non-lease components. What about hire purchase? Is it out or in the scope of IFRS 16, provided it looks the same? Do you understand? It's not, if you look at it technically, it may not be the same because the intentions are different. But if you look at the contract and you think that, oh, the features or the peculiarity of this is still the same, then it all depends on the situation at hand. Company A invests in power plant to produce or supply electricity under PPA, that is power purchase agreement, to a national grid for 10 years, with possibility of extending for another 10 years. Will you consider this as a lease scenario? It all depends on your understanding. Suppose an entity owning and operating a power plant where all the electricity output is sold to the government off-taker via a PPA for 20 years. The lessor recognizes the assets in its balance sheet, which is depreciated over its useful life. The lessee recognizes expenses of monthly payments. However, with the implementation of IFRS 16, the lessee will also recognize the lease assets. The assets and liability in his book. As the lessor will continue to account for the assets in his book under IFRS 16, this results in its book under IFRS 16 being, what I'm trying to say there is that there will then be a topical issue. If I'm recognizing that very assets item as right of use, should my lessor also recognize it as an asset? Otherwise, he will also be claiming capital allowance, and I will be claiming capital allowance. What happens there? So one has to go down for the other. So that was why it was not totally jettisoned overhaul in the books of the lessor. Do you understand? So, all right. Any question on this first phase? Plenty of questions.
Yes, the first one, we said we're recognizing it's using IFRS 8, the retrospective, the other one. The first one is making adjustments to prior financial statements. Now, first question for that one, what's the implication on this disclosure to investors, stakeholders? Is it like you now resubmit previous year?
No. Anytime we have this issue also in IFRS 1, when you are adopting IFRS for the first time, you have to make some statements and all of that. So you are not actually publishing another account. But anybody who pick the prior year account, let's say 2018, and is speaking 2019, by the time they are comparing, they will see that the figures here are not the same. But the disclosure in that 2019 will now tell you what happens. Why the figure in the prior year are not the same with the current year. But it's not as if we will say, oh, everybody we are giving 2018 accounts, we are bring it back. No. Do you understand? But there will be separate sections of the account that even tell you what were the previous figure, what adjustment do we make on the previous figure, and what is the restated figure. Is that restated figure we will now take to the body of the main 2019 account as comparatives. You may not get it very, very clearly. I'll see. We might probably underpaid or paid. I don't know for now. We might need to do. I know I'm technically owing my generation training on IAS 8 and IFRS 1. It is when I take those two standard that you will really understand what I'm trying to say. Do you understand?
Next one, 9. What if the retained earnings?
It doesn't matter. Pass the entry. If it's then zero, which is not likely to have happened, but even if it is zero, you then have retained loss.
So you remove it from the
yes, so you don't have retained loss. Depending on what actually happened. The adjustments can give rise to positive, can give rise to, you could have overcharged, you could have undercharged. So it then depends on what happened.
It's just that for tax purpose, so you might then need to now refile the accounts. Refile what we call an amended returns. Do you understand? But it still does not mean that we are withdrawing the earlier one we have filed. Do you understand? If the impact is then very material, you then have to do an amended returns. It is, you know, like I said, it's either way. It can then make you also to have credits. But trust me, no tax authority will give you, recognize your tax credit without, no, they can. They may in the long run, but not until after tax audits must have been conducted.
What if that happens as a result of an error?
An error on which side now? On the taxpayer? Yeah, if it is vivid, yeah, if it is vivid that an error occurred, it can be either way. An error could have occurred that made you to overpay tax. Do you understand? An error could also have occurred to make you underpay tax. But you have dictated what happened, you have amended it, and you now want to file the amended returns. But they will not just accept those disclosures from you without vetting. So they will come to your office, say, we want to do tax audits, right? After checking all the books, if you say an error has occurred, we should have an audit trail where we can verify, oh, this is what happened, this is the document, this is what happened, this is the document, this is what happened, this is what we get it wrong. Do you understand? Provided you can convincingly convince them that error is actually genuine and it has been corrected. But if you cannot convince them, they will have no other option than to hold on to a more favorable position to them, because they are not the one that caused you to make that error. Do you understand? Where the law allows them to choose to go with the less favorable position is when that error is as a result of our law. If it is a law that caused the confusion. In law, they say that whenever there is any lacuna in the law or any loopholes in the law that happens to appear as a disadvantage to the taxpayer, you have to interpret the law in favor of the taxpayer. Do you understand? So that is debatable in the law. Just like you do tax to an extent that you are technically dictated to talking and behaving like a lawyer. So it's then very interesting. So thank you.
My question.
Okay.
Does the standard permit you to choose either of those two, full or modified? You have to use.
Okay, so what the standard says, please copy them. What the standard says is that, for the caliber of the companies that this standard was actually introduced because of, it's not because of SMEs, it's because of the multinationals. And their transaction is so complex that they can even have a group of people handling leasing because they have so many. So what the standard now says is that if you are using either approach, don't say I have 20 lease arrangements. I want to use retrospective for one, full retrospective, I want to use modified for one. No. If you are using modified, use it across board. If you are using full disclosure, use it across board. But you have the option to choose whichever one you want.
Okay. But in terms of the financial impact on the organization of financial statements,
it depends on the issue that happens at hand.
okay.
So she will share some of the practical issues with you. You understand? So because she has encountered these issues in practice, right? She will take you through how the disclosure looks like and all of that. I'll still be around to give the necessary guide. So after that, we can now round it up with the tax implications. just to take you through all of these things we talked about. Then what are the various VAT issues, withholding tax issues, CIT, and the likes.
Thank you.
Yeah, it's working.
What? Any paper or something. Just a rough sheet.
All right.
So let's say it's a work on it. This class, the people who volunteered interest, they were as much as 5. Yeah. Training. He called you too, have you?
Yeah, he did. I think he called him yesterday.
He called. Okay. Let's just come out.
what?
No, how people were working.
There's nothing else. Okay, good evening, everyone. I just want to share with us the practical approach while of you. Excuse me, sorry, Mr. Cook. I need to go to the next sheet. Okay. Okay, I have a company as a case study here. Okay, a company leased a building from the government for 10 years with an option to renew for another period. The annual lease payments was 11 million. Okay, this company.
Sorry, hold it.
Okay.
Please pay special attention to this. This is practical. It's just because of confidentiality sake that we can't come up with the agreement and all of that. Do you understand?
Okay. Prior to this company had a prepayment of 6 million in their audited account as at the end of 2018, before 1st January 2019, when IFRS 16 became effective. Okay, so, and the lease agreement shows a period of 10 years. So this are the year, our cash flow, the yearly cash flow is 11 million. Then we have our discount factor, which I believe every one of us know how we arrive at this. So let me just put the cost of this so we can. Why is it dancing?
Sure.
Okay. Then the discount factor. The interest rate, okay, is at the end. Let me show us. The interest rate is 30%. I think Mr. Cole also have explained how we usually arrive at it. I think he did that.
Yeah,
the interest rate.
So let me then put better clarity to that. I said it, but I didn't stress it. Right? We'll be talking about what the discount factor is. But like I said earlier, when we were explaining that most of the drafter of this agreement are not accountants. So there are some features that you need to make your calculations that you may not have there. For example, you will see things like, you may not see things like interest rates there. So how then would you come about what the interest rate is? But you recall that when I was making the explanation around the very last solution we made, when I said you have to make, you are hoping that you will pay this sum over 3 years, and the capital is today. If you have the whole capital, you can put it in a promising venture, right? So the question you then ask is that, when you are in a similar shoe, what is a interest-free rate, which usually is a commercial lending rate that you could have used as a tool wherein, if say I have this sum, if I put it in a commercial bank now as a fixed deposit, how much interest will I have earned on it? That is one way of determining it. Because whatsoever you are investing this particular fund on, it must not be a high risky profile investment. Otherwise, you will then stand a chance of losing the whole money and not being able to meet your obligation. So it must be a risk-free security you're investing on. There is a higher tendency that what you fix in the bank, except for natural disaster or global, wherever, that could then make the interest rate to be extremely very low. So that's one way of getting it. But sometimes you may not need to go that route if you check the profile of the company and they already have an existing loan or existing investments, that if they had added this particular sum to, could also have earned the same thing. But note, in reality, are we actually investing this sum?
No. So it's just a fictional provisions. But we want it to be as close to reality as possible. And that's why we are using those venture. So in this instance, she will explain to you how they came about their own, because they visited the client in the field, checked one or two things and come about the.
Okay, now the interest rate was, the company does not have a loan that they were repaying. I didn't mean they had, we would have used that. But we use incremental borrowing rate, that is the bank rate, which as at 2018, because this lease started from 2018, before the adoption of IFRS 16. So that was what we used, which is 30%.
So my question then to Tomiwa, who probably may have the need to doing this for the employer, is this. You have an employer that have a similar concept. You don't have an existing loan. You don't have a similar fund where we could have gotten this interest rate from. You just need to go to CBN website and confirm what is the prevailing CBN lending rate.
As at when the
as at the date that
the agreement,
yes,
the lease agreement, yes.
Do you understand? But if the company already have several profile security that they are currently investing in, you can just leverage on that. In your disclosure, you also have to say how you came about your interest rate, because you are taking that as a finance factor. Do you understand?
So I believe we understand that, and for the discount factor,
it's exactly the same way.
The same way.
Exactly the same way. This is your regular payments.
Yeah, that's cash flow, then the discount
factor. To get, what are we getting here? We want to get the right of use, the actual cost of the right of use. You know, I said it also that there is a higher tendency that the lessor may not tell you what it actually costs him or her. So, but this is a metric on how to determine a likely cost. There may be little differences depending on what is the impact of your discount factor, which is your interest rates. Do you understand? But whichever one, in the long run, everything is still.
And when we are doing this table, I think he did his own separately when he was trying to arrive at the lease liability. But we can as well do it like this. It's more simpler when we do it this way. So you'll be able to see your lease liability at a glance. Then at the end of the last year, which is the 10th year, for you to be able to know that what you have done is right, it has to be zero. If there is no zero, then if it is 50 years, we had a scenario that we had a client that there, I think it started from 2006, it's around 50 years. So at the end of the year, it has to be zero. If it is not zero, right, that means whatever you have done is not correct. So now this is
sorry, by way of addition, it may not be that it's not correct. It may be because of rounding error.
Yeah, but it has to be a very minimal,
not insignificant.
Yes, not like at the end of the year we're now having like 2 million. No, that means it's not accurate.
But
that's what I'm trying
also
to
look at it. Insignificance is a form of judgment. You can have 2 million or something when the actual values are in billions.
Okay, let's say if you have billions.
So you should use the term immaterial.
Okay. In practice, I've not seen where lease at the end of the year there is a figure there. I have not seen. Even when we deal with dollars, we have to convert and go back to the year that lease started. The whatever the exchange rate. Even while we did that, we still ended up having zero at the end of the year.
Most definitely than not, you will have likely have the same thing. But this thing they call experience differs.
Okay.
Do you understand? Like you can say you have 30 years of experience and you probably have not done this before. If you don't have encounter a client that will result to this, maybe all of your clients are all property owners. They don't have any reason why they have to lease anything. So usually I'm this very much open-minded when we are debating some issues. I don't totally say
okay or yes.
Sure, you understand? Because you only know to the extent to which you have seen. Do you understand? But I've seen instances whereby you can have those fractions. Yeah, fractions. Okay. But it will be definitely very immaterial.
Okay.
sorry, before we want to ask one question. She said something about dollars. So now, once we are recognizing, once we are calculating, we calculate in the currency of the residents or
Okay.
the
Okay.
currency of the
So, which is also a function of experience. When I talk, you see that when I gave the illustration, I gave the Naira version. I gave it because I have clients who are not Nigerian.
Okay.
I'll be reporting in the currency of their operations. So that takes us back to IAS 21. What is IAS 21? So what we then inform your reporting currency is the primary currency where the company is actually being located. So if I've had clients that they operate in Nigeria, but their reporting currency is dollars because they are subsidiary to parent company in US. So what the US company wants to see is not the Naira. Do you understand? So they will then have two versions of the account talking about the same thing. For the purpose of you being able to relate with the local legislations there, but when you are now reporting to your foreign entity, you report in dollars. So which among these options you will then have to use? I've given you the decision factor. Where is your company located? So who does your company has primary obligation? You understand? If your company has primary obligation to a Gambian parent company, you have to report in their currency. That is why we are very magnanimous in our policies and our tax legislations. That is why the tax also recognize that there could be possibility for you to have transactions other than Naira, but they now put the caveats there. If you have transacted in dollar, pay your tax in dollar. Do you understand? So look at where is your company located? Is it a subsidiary of a foreign company? That will inform the reporting currency. But primarily, every Nigerian company you should have their reporting currency as Naira.
Yes. The one I'm even talking about is the Nigerian company, is a Nigerian Port Authority. They had a lease agreement with them. And you know, we Nigerians, whatever we are doing, we try to put it in dollar. So as to have, so that was the reason we had to use the old exchange as at 2006 when the lease started. We did the conversion for us to get the true picture of what it ought to have been.
Then, you know, for companies that has international clients, even though their reporting currency is in Naira, they will charge in foreign currency because of the exchange rates. I've had a client who is proposing to pay me now in Bitcoin. Except until when Bitcoin now becomes Wahala, that we now have to suspend the argument. Do you understand? But if it still becomes attractive, that is what they have. Except you have to wait for them to now convert the Bitcoin to dollar, convert it to Naira, and now transfer it. You understand?
Okay, can we go ahead? I don't need to explain all of that. I believe we understand. Okay, then the first year. Okay. The first year, we have to recognize our right of use of assets by debiting that and crediting our lease liability. That's exactly what the first journal is talking about. And secondly, our finance expenses, then lease liability as well. Then,
now, hold it there. Look at this. This is what they did practically. Is it different from what we did in the illustrations? Exactly the same.
Okay. Okay. Then on our depreciation using cost model, okay, we extend the.
Can you tell me how we come about this figure? That is this, I mean, for 10 years, right?
Okay. So now the second year, which is first. No, we are still going down. There was no, you know, that first year was 2018, which was rents It was rent and prepayment. So that's where I'm still going to. I'm still going to explain that.
Payments were in arrears, abi?
Advance. You know, they paid in 2018, which spill over to 2019.
Okay.
So that was the reason you're not seeing this day. So that's what I want to explain. You are still going now. So the second year, which is now the 2019, the IFRS 16 became effective. Then the 30 million is our right of use of assets. We're supposed to have, based on what we calculated up there. Let me go back. So you will see, this is what we're supposed to have, which is the brought forward from year 1 to year 2, which is our lease liability and right of use of assets as well.
That is the 33, right?
Yes. So in order for us to get the 33, you know what we are having here now is 30 million, right? Which is the 34 million minus 3.4. You can see IFRS 16 adjustments.
So you tell us what method
So
you use.
what happened actually is that when we were still using rent and prepayments, there was a prepayment in 2018 accounts, which will be the brought forward in 2019, right? So we discovered that this IFRS 16 adjustments come in place as a result of what we ought to have charged as our accumulated amortization, then amortization charge for the year, the difference between the two. Which, if we don't adjust our prepayment, there'll be a figure left there, and we're not supposed to have any figure there. That was what informed this IFRS 16 adjustment. Did I make any sense? Okay. So let me take us to where.
Tomorrow is lost.
Did you get what I just explained?
Okay, so what she's now then saying is that there are a lot of other disclosures that she will have missed, but because of confidentiality, she will not.
I will show you
This
guys
thing-
what
this
I'm
thing-
trying to explain.
This thing is resultant effect of restatements. Ordinarily, as at 2018, they were not entirely in this form, have you?
Yes. It was
So
just
but because we want
prepayment.
to walk back to know how to transit that prepayment approach.
Right of use of assets.
It was an
Yes.
operating lease. How to now transit it into meeting the condition of IFRS 16 now. They need to do all of those as well, but she will explain.
So what I'm trying to say is this figure supposed to be our depreciation using cost model accumulated amortization as at 1 January 29. But because we had a prepayment of about 6-point-something million in the comparative of that's 2018, then the difference between this and the 6 point whatever is this 2.6 million naira, which will go and adjust under our retained earnings. Let me quickly show you what I'm saying so that you get it better. Okay, now this is it. These are retained earnings brought forward. Then adjustments for adoption of IFRS 16.
You remember I said then that you have to adjust it on retained earnings where you have
That is the
if
cost
it was
model. Yes.
if it was 0. You remember you asked that if it was 0, and I say even if it was 0, still adjust it and now have retained loss.
Yes. So now I think this is like we are trying to reduce this retained earnings. This is 39. This minus this, the figure will be reduced. I think being what we charge now, for instance, let's take for instance this 2 points. Okay, you know, this is 3.4, and what we had in our prepayment was about 6 million thereabouts. So I think being we had lesser than that 6 million, you know, this will not be a debit entry. It would have been a credit by increasing our retained earnings. So, did I make any sense? Is it understandable? So that is the adjustment for that. Before we now get to our payments for the year, then we now adjust for the accumulated amortization during the year, then the finance expense. So in 2020 now, when we are auditing these people, we don't need to go back and do adjustment on retained earnings again. All we have to do is just between our lease liability, then our finance cost, then our right of use of assets. So I can still show us how that one is as well. Then the disclosure. Then these are right of use of assets. Exactly what I mentioned. You know, in the second year, which is 2019, we had 30 million on that table. Then the amortization charge, which is this. Then our carrying value will be this. Let me take us back to that table. Before we get to our disclosure, then we now have to explain all what Mr. Ko was, what he told us. The company adopted IFRS 16 retrospectively from January 1,
Remember I said you have to tell.
but has not restated the comparative figure for 2018 reporting as permitted under the specific transitional provisions in the standard. The reclassification adjustments arising from the adoption of IFRS 16 are therefore recognized in the opening statement of financial position on January 1, 2019. And going further, then all the IFRS 16 introduced a single on balance sheet, all the story and the likes. Then before this, if you go to the company's financial statements and you check under the accounting policy, you will see what we use, cost modify approach that we use. It was stated there. So this is how it is exactly in practice.
So any question? It is not a function of, like I said too, this class we have been more likely if we have taken IAS 8 before. You understand? Because IAS 8 talks about how to do correction of errors, changes in accounting estimates. You will have seen all of those interwoven and all of that. But we'll still have that in subsequent section, whether paid or free section. If you then compare that with what you have now, it makes it more engaging. But trust me, there is no better way to retain any knowledge you have than having further engagements. You understand? So when you read lease contract now, rent agreement now, what you are seeing there is different from, oh, agreement between Lagbaja and Lagbaja. All of these things will now be coming to your mind. You might even pick it, do rough estimate to know, to further reiterate what you have done. So that's that. So let's round it up with, but also note that as you have known, our approach is that the fact that you have the first practical class, whenever you have any challenging issue of this, you can always reach out to me anytime, right? You can always reach out to me anytime. So the last aspect before we round it all up is the tax implication, right? So tax is an implication of adopting IFRS 16. So I'm sure by now when we do, let's do all of these teasers. Dash is the effective date of adoption of IFRS 16. Okay, the standard setting body in Nigeria before the adoption of IFRS is what? NASB. The standard setting body in Nigeria after adopting IFRS is what? The IFRS 16 provides a total replacement of IAS 17. Pause. Yeah, I told you nothing changing in book of the lessor. Yes, now, as far as the lessor is concerned, you're still partially using it. That is what I mean by it's not a total replacement of. But because more engagement, the most of the engagement you have is on the lessee. Who is actually doing the manipulation is the lessee. That's why this came up. So early adoption of IFRS 16.
What can the government leases now?
Partly IAS 17 when you are talking about the lessor.
Okay, so IAS 17
it is not, because it says nothing changes in the book of the
Oh, okay.
So early adoption of IFRS 16 requires compulsory application of what? Yes, you remember? So here we'll be talking about the overview of, I might not spend so much time on because the class was still, it's still fresh. Reason for this, benchmark for this and all of that. Let's see. So the overview, I've before now discussed about why lease transaction, the old standard, when we used to use SAS is SAS 11, which I said it is no, there is no material difference between the standard and IAS 17. It's recognized both operating lease, finance lease, and all of that. The new standard is IFRS 16, and we've talked so much about. So what we'll be laying more emphasis on is the tax implications and the questions. So why leases? We talked about, because it's so much expensive to acquire these assets in the first place, we have to might consider the option of getting them on lease. Ease of credits. Is it actually easy to actually get credits? It's not. So that's also why we opt for lease arrangement. Tax advantage, because if you have actually incur, if you go on lease, the extra charge that you had as a finance cost is also allowable. If I have bought the asset myself, I will have bought it at 85,000, just like in one of those examples, right? But this time it's costing me 100,000, and they are still recognizing as allowable expenses for me 100,000. Do you understand? Without which I will have more income exposed to tax. Do you get that? So I have the convenience of getting the asset that I wanted as an option to taking an exorbitant loan, right, at higher cost. Then the extra cost I'm still having on it is still tax allowable. So there is no reason to overburden myself, right? Then alternative source of funding, I've told you about that it provides an option to actually funding business. Then comparative advantage. So if even if I can afford the money, the cost of that asset, and I know that going through the route of lease, I can still get it. So I can invest my money in another profitable venture and still use the option of the lease to still get my needs met. So comparative advantage is, that's what I mean by comparative advantage, trying to concentrate or use your resources on what will give you the maximum benefits. Then scarcity of foreign exchange. Yeah, most of the assets that most of those group of companies may need that warrant them to do all of these manipulations requires heavy or so large foreign exchange, because most of them have to import those heavy duty assets. So rather than still looking for foreign exchange in the mix of the scarcity, let's look for who has it locally and lease it. So these are some of the reasons for that. Then lease generally, I said, even in our old standard, was well recognized. So then we call it SAS 11, now we're calling it IAS 17. And it's recognized both an operating lease, finance lease. There is even what we call capital lease, leverage lease, sales and lease back, and all of that. They are all recognized, just for information's sake. The leverage lease, it's more of a tripartite relationship where you have the lessor, the lessee, and the financial institution, right? So what they're just saying is that, oh, the lessor needed, how do I explain it? I need this building. I own this building, or I'm open to owning this building, but it will cost me 100 billion to acquire the building. I can then, the lessor this time, can then approach you as a bank, say, give me the advance to getting this building. The question is, how do you then repay? I will not tell you, I have a ready-made I mean, I have a ready available lessee who want to take the building on lease, who will continue to make the rental payments due to me directly to you. You will then be removing your money with your interests. Upon the completion of the total payments, they revert the balance to me. That is a leverage lease. Do you understand? It's common in marine, where you have marine and oil and gas, where you have heavy duty assets. Do you understand? So I know that because I have the connection to getting that thing, but the people that want to sell it to me need money too. Do you get it? So I'll approach a bank, finance this purchase, and sometimes it can be partly financed. I can drop some, maybe I have some other money, but I don't have all to complete it. So I'll open a standard account with the bank. They will fund it, will pay off, then give it to the lessee. Lessee will then be paying directly to my account with the bank, which will have been first debited. So as the money comes in, bank removes their own. As the money comes in, removes. So maybe it's a 3 years payment, right? Or 10 years or even 20 years. Anytime I fully recover, the bank fully recovers the loan with the interest, then the drop is then becomes a positive. Do you understand? So we call that a leverage lease. So this is just a talk around what's the form of a leverage lease. So we've talked about the effective date, we talked about the recognition, how, when, at what point do you recognize, how do you measure, we've done several things on that. What are the exemptions? That is what we talk about, the short term, a short lease or the low value lease assets, right? Then how do you present? That is how do you make the presentation on your income statements and the likes? Then disclosure, the additional stories you have to tell about it. So this is just a further. Now, on the tax implication of lease to a lessor, right? What is the tax implication to a lessor? A lessor could likely have an operating lease and it could likely have a finance lease. If it's an operating lease, the major thing, depending on what is the lease item, right? Sometimes the lease item can be vatable. Sometimes the leased item can also be open to withholding tax. Do you understand? Depending on who the lessee is, right? Because the leased item gives rise to income to the lessor, it may definitely be liable to CIT. Do you understand? And it may definitely sometimes be liable to CGT when I then, as the lessor, want to dispose the assets. So we look at that under operating lease, we look at that under finance lease. Do you understand? So I said all the operating lease that the lessor could do could give rise to VAT, could give rise to CGT, could give rise to withholding tax, and could give rise to CIT. I hope I'll be able to, clear that, because your income, you recognize an operating lease income, which is subject to CIT, provided you make profit after deducting all expenses at the end of the year. Do you understand? Because the lessor, which is the leasing company now, the account will be audited, tax computation will be made. The primary income is rental income or leased income. So if eventually you have taxable profit at the end of the day, it will be open to CIT at the substantive rates, right? So depending on who I am actually transacting with, if I'm leasing a building for residential purpose, it will not be vatable, because that is a VAT exempt. Do you understand? But if I'm leasing it to other entities, it then becomes vatable. Do you get it? So Then, of course, if I'm also transacting with a fellow incorporated entity, are you there? If I'm also transacting with a fellow incorporated entity, before they pay me the least amount, they will have deducted withholding tax. However, withholding tax is not a form of tax. It is advance payment of the CIT. So anytime I want to dispose the assets and I'm disposing it at a value higher than the cost which I acquired it from, then CGT then comes to play at 10% of the capital gain. Is that clear? So let's look at what is open to a lessor in a finance lease arrangement. Same way, finance lease, we definitely accrue VAT depending on the nature of what we're actually leasing. But there is there is a waiver on lease, finance lease or operating lease of land. Land is not vatable because it's not a supply of goods. Do you understand? So when you have most of the leasing companies that lease land, there is an express circular on it that make lease of land not vatable. But other items that you are leasing, and of course, bride price is also not vatable. You know, I use those illustrations in most of my classes because it's things, sometimes it looks too serious and it just dials the tension and we come back to status quo. All right, so if you have taxable income at the end of the day for CIT, you have CIT being exposed. Then, of course, before they make the finance lease instrumental payment to you, they will have deducted withholding tax. And eventually, by the time you will then now be disposing the finance leased assets to the lessor, if it is disposed at a value higher than the cost, then CGT comes to play. Is that clear? So in the book of the lessee could have the finance lease, it could have a small lease. Tax does not recognize IFRS 16. Do you understand? Well, as far as we are concerned, all our tax law are done in line with SAS as of today. So whichever form, even if though you are calling it finance lease, small lease or whatever, they will look at it in particular, what is the peculiarity of its transactions and address it as it is. So small lease, what we can then call small lease, provided it is not land, any leasing arrangements, provided it can also be constituted or interpreted as a supply of goods. If I'm leasing a laptop, machineries and all that, it's a supply of goods. So it will then be vatable. But you could have it as small lease, you can have it as finance lease. But emphatically in the finance lease, you're expected to, if you don't want to shortchange yourself, decouple it into lease components and the non-lease components. So let's look at tax implication of finance lease to a lessee. So the lease component and the non-lease component. On the non-lease component, no taxes is applicable. Do you understand? On the lease component, you will also further separate it into right of use of assets and the lease interest, right? That lease interest is allowable for CIT. It's not that you are paying tax on it, but it is allowable expenses for CIT. So it has a CIT implication, right? At the point that you want to, if you then report a lease interest, they are also expecting that it could then, depending on the transacting party, it could then be liable to withholding tax. Do you understand? If actually you invested that sum, you know, that was a notion. If you then actually invested that sum, as we have proposed that you will do, at the point that the interest will be paid to you, provided it is originating from an incorporated entity, when they are paying you the interest, If you fix the money with the bank now, the bank will have deducted withholding tax. So that's why we say the withholding tax can be there. Then it is not vatable. Interest is not anything. Interest is not related. I mean, it's not vatable. It's not a supply of service. Then it has no, because you are not making any disposal. It has no CGT implication too. But coming on the right of use, it is liable to CIT because the underlying asset, which is the depreciation, is treated as an allowable expenses. But if they so decide not to treat it as allowable expenses, they should give capital allowance in lieu of it. Do you understand? As at the point that you are making that right of use payment to the lessor, you are expected to deduct withholding tax, right? Then, depending on the right of use item, right? If it's land, it's not vatable. If it's any other thing, it would then be vatable. Then, at the point that the disposal is being made, but note this time you are not the one. You are not the one making the disposal. So, to the lessor, there won't be CGT, right? Because you are not the one making the disposal. You are the one buying, likely to buy. So CGT may not come to play. Because you are also not the one that is actually supplying the good, VAT may also not come to play. The VAT will have been charged in the book of the lessor. Do you understand? But its possible implication on CIT is that it is an allowable expense, whether as a depreciation or in lieu of capital allowance in lieu of depreciation. So I hope you are with me. All right. So it is as simple as that. With that one, we've captured all the possible areas of tax that can be exposed to that lease transactions.
In the books of the SOP, assets, you said something earlier that prevents fraud calculation of claiming capital allowance. We saw the bank represent as an asset, or the receipt can represent as an asset. So is the resource supposed to identify it as an inventory, or how is it also represented in its own books?
Okay, so that will take me back to the issue of control. When the lessor gives out an asset as a finance lease, you are earning a principal income. So you should be recognizing that item as an asset to you because it's no longer your asset. Because the longer you still retain it as your asset, you will then still be able to say you want to depreciate it and all of that. So sometimes, depending on the nature of the assets, you might need to reclassify it as investment property or in line with IFRS 5, non-current asset held for sales and discontinued operation, depending on the nature and the peculiarity of it. Do you understand? So that then means that depreciation will have been suspended, even though you might still be reporting it under the PPE section, but you are not subjecting it to depreciation. Go and read about IFRS 5. Any asset reclassified as in line with IFRS 5, depreciation is suspended. Then any asset classified in line with IAS 40, investment property, depreciation is suspended. So most definitely than not, it will more likely be regarded as an investment property rather than anything. So if you look at most of those leasing companies, what they have there is investment property. If it is still a finance lease, an operating lease, then it can qualify as an asset in their book. Okay. If what the nature of the lease arrangement they had is an operating lease, you can still retain it as your asset. You can claim depreciation because you have regular costs of repairs, insurance, and all that. But when you now give it as a finance lease, you have to derecognize that asset and reclassify it as investment property.
The investment property
Yes.
appears
PPE, but as a separate line item.
So how do you now recognize source of just
Yeah, it will continue to be, when you say an investment property, IAS 40, it is usually applicable on land and building. So assuming KCP owns the whole of this building, but we are only using this place, but we sublet the other, which is a lease. In our book, it would be wrong for us to now capitalize the whole of the cost of the building. So what should form in our land and building is the cost of these flats, while the remaining section of the building should be reclassified as IAS 40, investment property. So until you sell an investment property, you will not depreciate it. The standard forbids that you depreciate it. You can only retain it as a source of revenue or dispose it outrightly. You can see we have a lot to actually discuss about. Do you understand? But if it is any other asset other than land and building, you cannot reclassify it as investment property. You can now reclassify it in line with IFRS 5. Or simply, and if that one also has its own conditions, because there must be intention to sell within 12 months and all of that. And some of those your finance lease may not meet all those conditions. So you can then reclassify it as an inventory. Because it then constitutes something like an inventory to you. You just have to suspend depreciating it, because you don't have the right to claiming those things again. Because the unique feature of an asset, of a fixed asset or PPE, is that there must be this control. You don't have control over it. So when you lose control, even if you are reporting it still as that item, in your PPE, you should now come down and say that, oh, because this asset is under a finance lease, we have lost control. As a result, depreciation on it or write-off on it is suspended. Until that time when you now outrightly dispose it, to now benchmark it, whether you have a gain on disposal, a loss on disposal, which will then be open to CGT. Do you understand? So that's where we will end it today. I will like that you continue to engage. Okay, you have one more question.
For the CGT, the CGT will not affect the lessee because it's not the one who sells the store. When carrying now is so determine capital gain. You, of course, you compare the sales proceeds with the carrying amount for
The cost.
the cost.
Because note that CGT is not an accounting issue. It's not an accounting issue, it's a tax issue. You have Capital Gain Tax Acts.
Okay.
Right? And it says that whenever you have a chargeable asset that you are disposing, you will compare the years when you bought it, even if it is 2000, how much do you buy it? Had the cost to sell it, cost like marketing costs, brokerage, and all of those stuff, add it to it. Then how much do you recover from its sales? Do you understand? So for most assets, other than land and building, it will not result to gain. But for land, and building, it may definitely result again because it is assumed that some other non-economic factors will have make it to appreciate in value.
When we are saying is an asset that is
Provided there is capital gain.
But there's no money with the capital gain against land and building.
It depends. It depends. During the period of COVID, dollar, even up to date, dollar so high that if you now compare, okay, our regular Corolla, that's more global one. If you compare the market value now, before now it's around 1,750 thereabouts. You see people during that COVID or shortly after COVID, people selling that Corolla even for 2 million Nigerian use.
What if you use this?
Because if you have to now say, I want to buy the Tokumbo, it's around 2.5 thereabouts. So depending on economic factors that happen.
Second question is here. The lease payment from the city to the software in the books of the lessor now, or CIT for the city because I'm not different.
Yes, we now use that credit note to offset the CIT. All right, so that's where we call it a day today. And that makes us come to the end of IFRS 16. Next week, same time, we'll be handling IFRS 15. Then if you're able to complete that, we might take that alongside with IS2 because no much complex story around it. IFRS 9 will take us complete 2 weeks. 3 months is not enough for IFRS 9. But we try to make it as meaningful and as explanatory as possible. So we take it for the last. So, but you do us a good to always tell of the good of honest view of the value of what you have earned to others, right? Because I think that beyond the money, there's a lot of knowledge gap actually among professionals. A lot of knowledge gap. And when people say there is actually no job, it's not always true. What we have found out is that there are very few people that has a requisite practical experience that can actually earn those jobs. So that's why we came up with this. If you check others, even IFRS 9 alone, the least place you can see the training is 100K. Just with the intention of just trying to contribute our own quota to actually say, okay, let's make the world a better place. Let's try to rob what we have been privileged, because everything is privileged. Everything is privileged. What we have been privileged to be exposed to, let's share it with others, right? So that's it. So try as much as possible to reach out to your other colleagues that you think they need something like this. We will be doing this more often after this trip. We're doing this more often because a lot of other people that will have even been willing to even pay more for it, because it's a physical class, they could not attend, they are not in Lagos. But we'll see what we can do to actually blend that gap. Also, it will do us a lot of good if you make the best use of what you have learned. Trust me, the best way to retain your knowledge is, even if you don't have clients or employer you're serving now, volunteer for free services. You do yourself a lot of good and engage in meaningful engagement with your colleagues. That's also how to retain knowledge. Put up meaningful discussion or arguments around this and this and this. It will shock you that Many things you have learned, they have a wrong opinion about. And many things that maybe this training and other encounters of yours has not even covered, you also learn from them. Then we'll be sharing this recorded section as soon as it's available to you. You can also share it on your various social media. Yeah. If we don't do those free ones we've done, you probably will not know we can do all of these things we're doing. Do you understand? Share it. You being in a physical class can never be like somebody we just see the recorded session. They will have a lot of questions they want to ask. They might not have the opportunity to then ask. Do you understand? So that's it. I wish you all the very best. Then tell of us to people that you think